You've done
Parts of it embarrassing.
And the wind gets going, Lisa, and this is not funny.
It's devastating. And the pictures and the images and the idea of people jumping into the ocean and having to be rescued in the ocean to escape the smoke and the fire, devastating.
We'll keep you up to speed on that story, Tom. The latest overnight.
The latest there, and we'll have much more on that through the day. And right now, on inflation, I guess there's no other topic this morning. He's chief economist, head of global economic research at J.P. Morgan. Dr. Bruce Kasman joins us this morning. Bruce, I'm putting the time series together. Am I doing it right? To guys like you and Feroli, do you take 90 days of data and then figure out a trend? Is that how we should look at the report this morning?
I think to some degree, but I actually would say in inflation data, it's very often that a 3-month run rate is moving in a volatile way around the trend. Remember, the first 3 months of this year, we had really high core inflation. It looks like June and today's July report are going to give us low inflation. I think we're going to have to wait a while on the inflation numbers to get a clear signal of where we're settling. We're clearly coming off where we were last year. It looks to me like we're going down at least into the 3s. But I think the number we're going to get today, which is suggesting something in the low 2s on a run rate, is probably understating where the trend is right now. There's a lot of volatile components, some of which are helping us now, but won't be helping us a few months down the road.
The trends, the first derivative, the slope of this disinflation, does it cause impatience at the Fed, or are they comfortable with the trend?
I think they're getting more comfortable with it. I mean, there's obviously a lot of way to go before we see where we're going to settle, but I think they're feeling better about what they're seeing in the inflation news. They're feeling better, but not that confident that they're getting a labor market which is cooling off and taking some pressure off. And obviously, they are okay with an economy that is growing in that environment, although right now it still feels like the economy is doing a bit more than they would be comfortable with in terms of getting this thing to stabilize.
The more comfortable the Fed gets, the more uncomfortable a lot of people in markets are getting, in particular when it comes to the long end, when it comes to longer-term inflation. Do you buy this, that the idea that the Fed is hoping for a soft landing and leaning into that leads to higher inflation for longer as it's being priced into the market?
I think it's appropriate for the Fed to take a pause here and see. I mean, any of us who do this for a living have to be pretty humble in our ability to understand where the inflation process is taking us. However, I think there is a pretty good chance that a pause here does not mean the Fed is actually done. I think labor markets are still tight. I think psychology has shifted here. As I said a minute ago, there's a lot of temporary forces, auto prices, health insurance that are pushing down inflation now. They're not going to be with us for a while. So I'm personally of the view it makes sense to take a pause, but I'm also of the view that's more likely than not when we look at inflation next year, it's going to have a 3 in front of us at the core number, and the Fed's not going to be thrilled with that.
Right now I'm looking at market pricing, and it's calling for basically the last rate hike to be at the last meeting. Very little chance of a rate hike next month or the month after, or rather in November, and then cuts starting early next year. Do you think that's plausible, given some of the momentum, given the idea that we're probably going to see real incomes continue to increase as inflation comes down?
I think to get the Fed to cut in the next 6 months, you need a recession. I think the idea of the Fed cutting requires us to have without a recession, requires a fairly decent amount of time. They get it comfortable that inflation is moving below 3% on a sustained basis. Probably to get that, they'll also need to see some rise in the unemployment rate. That's not my view of where we're going to be. It's certainly possible, but it's not going to happen quickly unless the economy really breaks down.
Right now we're looking at the various components, the used auto car prices. We're looking at housing prices, rents. What is the key component of inflation that you think is the most important to keep watching? Because everyone has something different.
Can I answer that question with yes?
No, you can't. Try again.
I don't think there's one or even two pieces to this. Obviously, you mentioned a couple. There are a few volatiles here that I think we want to look through: the used car prices, the airfares, the health insurance. The shelter stuff is really important in capturing the trend. It's clearly moving lower. And then we want to look at what the underlying movement in core goods and core service X those factors are, which have been still pretty elevated here and have not yet really shown the meaningful downward trajectory.
I'm going to rip up the script here, Bruce, with the great work you've done over the years on Asia and all. I'm looking at euro yen really at a tipping point right now. Take out the dollar. I got relatively strong euro. I've got the oddity of a weak yen. I'm out at 158. I can't imagine going 160, 162. It's a BOJ proxy. Maybe it's an MOF proxy as well, using the alphabet of the Japanese system. How fragile is that right now? How close are we to a Tokyo tipping point?
Well, I actually think we want to keep both pieces of that cross in mind. So I don't think we're quite there in terms of thinking about a more significant move from the BOJ, but the pressure is brewing. Personally, I think, we should be mindful that as we turn into next year, if the Japanese economy continues to deliver high inflation and strong growth, that we should expect surprises from the BOJ. But the other side of this, and it's the one that puzzles me, is the strength of the euro against the backdrop of the euro area actually looking like the weakest link in the global economy right now. That's the part of the world that troubles us from growth. It's not the US, it's not Japan, it's not even China in a major way. But euro area data has been very weak, and it doesn't make sense to me that the euro is as strong as it is.
You're not alone, Bruce. Kit Jukes
You
earlier
mentioned
this
it this
week.
morning.
Kit
John,
said the same
you're on
thing.
this.
Kit Jukes of SocGen asking the same question. Bruce, thank you, sir. Bruce Kasman at JP Morgan, looking ahead to the inflation data a little bit later this morning on the FX market as well. Two things. One, Bundesliga available on ESPN Plus in the United States, TK. So
yeah, but it costs me $99
right
a month
that.
in the bundled package to get it. I mean,
Prices
I guess
are
I
going
can
up.
watch the
But it's
Star
Harry
Wars
Kane.
stuff. Andor's in,
At least that was good. Point two, Dan Ives of Wedbush weighing in on what Bramo's got to say, the question she's asking this morning, whether parts of this is up for sale, and whether the likes of Apple might be a buyer. Dan says this: our view continues to be that Apple will not buy Disney, given strategically it would not fit in Apple's ecosystem. That said, we strongly believe if Iger, the board, decided to sell ESPN, this would be a highly attractive asset for Apple. In just a moment from now, we'll catch up with Jessica Reif-Ehrlich of Bank of America on the Walt Disney earnings. Tom, there was this interesting exchange on the earnings call. I wouldn't say that Bob Iger engaged in it, but it was the fact that he didn't push back aggressively against it that stood out for Lisa and others.
Yeah, I agree. I would say that away from the minutia, and to have Jessica on today is with her experience on this, these are McKinsey-like. This is like the guys in the Patagonia shirts at Sun Valley, that trip we don't go on. The conversation Iger has to have is like a Sun Valley conversation.
Are they Patagonia?
Naval, yeah, well, no,
you
they're
think we should
Wagner.
send
I thought they like
I mean, it's like Lisa going to Davos. She won't.
Brunello vests, aren't they?
Yeah, exactly. They're Cuccinelli or Cucci, whatever it is. It's like Lisa and Wagner at Davos. I mean, they're all decked out. And the answer is,
he speaking
that's the
English?
kind of conversation Iger's having right now. He's not worried about the price of a ticket at Disney World or whatever it is in Florida. I've never been.
You never been? Never been
Never
either.
been.
We went to Disneyland Paris once.
Really? How was
Pharaoh
that?
Clan did.
Yeah.
Not good.
Yeah.
Complained, they sent us free tickets, didn't use them.
Anaheim
That's
is
how well that went.
Anaheim
I went
is
once
out of this world.
when I was
Anaheim
5
is-
to Disney World.
Anaheim is the best. It's tiny.
Every time the family went anywhere but Italy, it didn't work out. There was always a disappointment.
And letters written.
Yeah, it's a very Pharaoh thing, just to, write a letter and complain about something.
All the kids had to
shocked.
submit their letters and see which one was the
My
best.
mum coming out of there, they're getting a letter.
Framed, signed.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I think we're in the beginning of a real transition of Disney's assets. I think Disney can work their way out of it by focusing on parks and fixing profitability on streaming. I do think the story is, if you look at the value of resort assets, where they move to, Disney stock is cheap if you think about it as a different type of company led by resorts and hotels and parks.
In many ways, Michael nailed it just yesterday. Michael Nathanson there, senior research analyst at SVB Moffett Nathanson, going into the Disney earnings. The earnings were better than expected. The revenue wasn't. In between, it was all about the cost cutting. Some of that partly due to the strikes taking place over in Hollywood. They're going to be pushing up prices for subscriptions to various streaming models. Tom, ultimately, they're doing that even with subs coming in light in yesterday's report.
Yeah, I think you're 100% right about the bold nature of the subs coming in light. It was international subs and also United States subscriptions coming in a little bit light as well. This is a joy, after Michael Nathanson yesterday and talking to Rich Greenfield from time to time, to speak to Jessica Reif-Ehrlich, senior media entertainment analyst at Bank of America, is an honor on this important day for Disney. Jessica, I don't want to talk numbers today. I don't want to talk ratios. Iger wakes up, I believe he puts on his pants one leg at a time. He goes into the office or takes breakfast at some place with avocado this or a glass of pure water. Who does he speak to within Disney about the urgency of a true restructure? Who's he actually talking to?
I think that is a great question, because there does seem to be a lack of confidence within the company, given the exodus of executives over the years. And so reportedly bringing back Kevin Mayer and even Tom Staggs should, give Bob Iger somebody with experience to kind of bounce things off of.
But the issue, Jessica, and you've lived this. I mean, you used to go in and Gordon Crawford would shake at Capital Guardian Trust because Jessica was showing up to give him wisdom on this. There was a business model. You made a movie, you made 4 movies for $100 million, and one of them hit big and everybody was happy. That model's been destroyed. What's the Jessica Reif-Ehrlich streaming model that will provide cash flow and profit?
Look, I think they're taking the right steps. I've heard you guys speak about the price increase, which is hefty. There's a 27% price increase for the subscription-only tier at Disney Plus and a 20% price increase for Hulu. Again, subscription-only. The advertising tier is not being touched because the ARPU is higher with the combination of subscription and advertising. So they're kind of forcing consumers into the lower-priced advertising supported tier. So that should help the bottom line. They did say that costs are ahead of expectations, so they'll have more than $5.5 billion in total costs being taken out of the company. A lot of that is streaming. So it's content, it's marketing, overhead, et cetera, SG&A, et cetera. So they're focusing on that. On the content side, they do need to improve, no question about it. And Bob Iger said last night, this is his primary focus.
Well, primary focus in order to grow the platform or in order to prepare it for some sort of spin-off or sale to someone else?
In either case, whether it's keeping it internally or selling or spinning, they need to improve the content. And it's, the content on the platform has to be improved. He said in the past that it's been getting tired. They have too many, there's just everyone's getting distracted. And obviously the one place where they've really missed is in film over the last, couple of years. And this is his primary focus. They have to fix that film division.
So this sounded like a Bob Iger in retreat, defensive, not really aggressive and offensive, not planning out some sort of expansion kind of plan, but rather really not pushing back against the suggestion of a sale to Apple, either in some of the parts or in a large sum. And you're looking at a situation where people are questioning what the value of the company is beyond the parks. Do you think that it is valid to really characterize this as Disney in defense?
Well, look, they are clearly challenged from multiple areas. They have secular challenges with the pay TV universe in decline, as do all traditional media companies. There are also cyclical challenges, which all companies are facing. But they have incredible assets. They have incredible branded, unique IP. And so this is, so they're dealing from a position of a challenge position on one hand and a position of strength on the other. And it does feel like, yes, there's some defensiveness because they have to fix what's wrong, and there's a lot that's wrong, but he's also dealing with each piece of it. So whether it's leveraging the ESPN name, with the deal with Penn, or, focusing on different parts of the business, they're with costs of growing the subs. On the sub numbers, I know you guys have mentioned that they lost subs, but a lot of the subs are 50-cent subs in India that don't financially contribute.
Right. Jessica, just give me a 3-year vision on who's going to win at streaming on a buy, hold, sell basis. Who's your winner out 3 years on the streaming wars?
Well, obviously, Netflix is doing incredibly well and in a great position. We also think Warner Brothers Discovery with Max, which is really just at the very, very beginning stages, is in a phenomenal position, given their extensive. They don't just have the biggest library, they have probably the best library in the industry. And I think you guys have been a little tough on Disney this morning because if you add Disney Plus with Hulu, with ESPN Plus, they are well over 200 million subs. So they have a lot going on. But look, there's a lot to fix. And I absolutely agree with that. And it does seem like they're taking many of the steps that are necessary to fix this platform.
Jessica, we're being tough because our subs aren't 50 cents. They're like $80-something a month. Jessica, thank you. Jessica Reef-Erdig of Bank of America. Appreciate it. Tapestry, think Coach, Kate Spade. Capri, think Jimmy Choo, Michael Kors. Tapestry to buy Capri for $57 a share in cash. Are we saying Capri or Capri in America? What are we saying?
I would say Capri.
I would say Capri.
I mean, I think
very American.
But I don't know.
Capri.
I'm not really an expert.
Although it's out of London, so maybe not.
I assume they mean the island off the coast.
No, I think they mean the pants. It's like the women's pants from like the 50s Mad Men.
Oh, Capri pants.
But it's Capri.
Oh, right.
Capri. I would call that Capri too.
Okay, nice. All right, Capri.
Okay, this thing is 6%.
Well, let's get to the news, Tom.
From Tapestry, John, Tapestry, which I hate, Coach, which invented the leather belt, frankly, in America a million years ago. Coach is, well Capri, let's go with that. Capri is 6% the size of LVMH.
Yeah.
So this is a bolt-on for LVMH, a bolt-on for Tapestry, whatever.
But the point of this is exactly because LVMH is so big, because Kering is so big. How do you compete with some of the giants that have really gained increasing prominence? Hermes, like all of them have been doing so well this year, in part because of scale and scope as well as the selectivity. So I wonder, Jimmy Choo and Versace, okay. Michael Kors maybe a little less so, since that's more, that you see.
Coach has no place in a conversation about LVMH, does it? I mean, come on.
No, that's
but
the
they're
point.
trying to. That's the whole point, is that they want to, if you're talking about Versace.
I think the team at Bloomberg Intelligence is really good on that. We bundle luxury all together because they're all in the same 4 blocks on Madison Avenue. Farrah's there every weekend. And the answer is they're not all together. There are 3 or 4 big winners. Kering owns 6 companies. Right. John, you know better than me. But the answer is there's stratas of luxury, and they're buying a train wreck. $52 a share gets them back to my long-term moving average price decline of Capri. I mean, the thing has been a 10-year train wreck, to be direct about it, and they're putting them out of their misery at a center tendency right now of 52-ish.
$8.5 billion deal.
Yeah.
Tapestry's down in the pre-market by a little more than 5%. Look at Capri. It's running pretty hard off the back of this deal in a pre-market, Lisa. Absolutely surging.
I just wonder, okay, yes, obviously they're getting bought out at a higher valuation than they were previously valued for. I wonder how important it is to have scale, how important it is to have the dominant figure in an industry. For the luxury brands, how much LVMH, how much Hermes, how much Kering really benefited from their size during the push and pull of the pandemic. And that, I think, is really the key question underpinning a deal like this.
Don't you think Capri just sounds.
Oh, no, John, you're dead on.
Yeah.
Sounds better.
Than No.
Capri.
No, Capri. I mean, it's
Capri.
Capri.
No,
Capri?
you're right, John. I agree.
Wait,
but they're out
Why?
of London, so for all I know, they got the
I've got
Pharaoh
no
thing
idea.
going.
Capri.
Find out. See if they want to come on air and chat luxury. I doubt it.
Tapestry.
That pronunciation.
Based on what we just said about Tapestry. Maybe not. Evan Brown of UBS is coming up. Big day for luxury. No need to talk about China dropping some of the curbs around international travel and what it could mean for Chinese tourists to the United States. We'll talk about that in the next hour. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. A lot's happening on Wall Street.
There are so many factors that play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Everybody's improved. on sentiment, but the data is not telling the same thing.
The economy has really shown that it has been relatively insensitive to higher interest rates so far.
Strong wage growth is causing inflation, but it's a barrier to lower inflation.
I wouldn't be surprised to see the Fed go another 25 or 50 basis points.
I think by the end of this year, the economy starts to go into a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The mics are hot now, TK. Live from New York City this morning. Good morning for our audience worldwide.
Oh, for 24/7 Bramo.
This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. It wasn't Lisa this time. In your equity market, we're positive here by 0.5%. Inflation data in America about 90 minutes away. That's the big story of the week, Tom. It's the big story this morning. It is about 90 minutes around the corner.
It really falls into everyone, and I think for our audiences in radio and television, there's a global Wall Street audience that's looking in the Bruce Kasman world about what will this do, what will that do. Mostly it's a nation exhausted by inflation. Granted, nothing like Europe, nothing like the United Kingdom, but this is a nation exhausted by inflation of, say, 5% with wage growth of 2 or 3%, just as a talking point, the spread there, the difference. And the question to me, and maybe to Jerome Powell, is exactly when is this over?
How much pricing power is left? I think it's a really important question from company to company. It's a question we're asking of the Walt Disney Company, Lisa, who in some places putting prices up by 27%.
Even as subscriber numbers come down. So it goes to this question of, are people pushing back, or are they just basically capitalizing on the people and their diehard fans? There is a question of which areas can have pricing power and whether people will keep paying for it, and whether this is this rolling wave of inflation that can keep reaccelerating. And this is what Andrew Hollenhorst over at Citigroup thinks. Basically, risks around core and headline inflation switched to the upside in August, and risks are growing if a sustained acceleration into 2024.
And the pricing power thing is really germane. I mean, Margie Patel and Jessica Reif-Ehrlich from two different worlds both said Disney can pull this off. Does UPS pull it off? If they're going to pay John Farrell $170,000 to deliver boxes off a brown truck, do they have to raise the price of my UPS box? People are going, oh, of course they'll do that. Says who?
Had a lot of people come up to me in the last 24 hours inside the building saying, where do I apply? 170,000 to be a driver.
I know, but the whole thing here, we're in inflation. It's above 2%. We had this gift for 15 years. Who's going to pay for it? And the answer is there'll be less tomatoes in the can. That's a cliche.
Make
or
it
you
smaller.
raise a can of tomatoes.
Shrinkflation.
Yeah.
It's a big deal.
It's a big deal.
It's a big deal. Here's another big deal, an actual deal. Tapestry to buy Capri for $57 a share.
Nailed it.
Thank you. I had to think about it. I'm going with Capri.
This is busted luxury. I don't care what anybody
this
says.
is Coach having a look, Tom, at Michael Kors, right?
I mean, I'm on Madison Avenue. I go to Michael Kors. What do I see? Who's Michael Kors? I don't know.
He was the judge on Project Runway.
Pretty brutal assessment here, Tom.
No, I don't know. I don't.
What's Coach these days?
Come on, there's different luxury. We talk about LVMH, John. You're encyclopedic on it. We talk about Celine. We talk about Hermes, we talk about this, that, and the other. Are these names in that same category? You mentioned it earlier. I don't think they are.
They're not.
Yeah.
Well, what about Versace, Jimmy Choo?
Versace's up there.
Yeah, so some of them are. I mean, this is the question, is they are going across a range of different fashion outlets. Michael Kors does sell in a lot of the, department stores and discount stores. A little bit less so with Versace. So, they're trying to get a conglomeration here when size matters.
Capri also manages money on the West Coast, I'm told.
Ridiculous.
Just got that message.
Really?
Bloomberg subscriber.
Well,
they're entitled to have a voice on this program.
They're probably from London.
No, that's a US-based investor.
Capri?
Okay. No, the person who sent the message is a US-based investor. Anyway, Tapestry's down by a little more than 4%. Capri is higher by something like 50% this morning.
The names we're talking about selling 30 times PE, Hermes, the rest of them. I didn't know this. Tapestries, I'm going to be charitable, 12 times PE. They're not comparable. I mean, we say luxury for all of them, and they're not.
We're talking premium high street. Can we call them that? Sort of premium high street, Coach, Kate Spade, Stuart Wiseman.
There's Bond Street. There's like two Bond Streets.
We call that.
There's Bond and there's New Bond.
Then there's the high street. in the UK. Okay, let's get to the price action. Equities, never doing that again. Equity futures on the S&P, positive by 0.5%. Yields a little bit lower. Lisa here on a 10-year by a single basis point, 399.73.
It's CPI Thursday, 8:30 a.m. The numbers drop. Very curious to see core, very curious to see the interpretations and the market response. Arguably, that's the most important thing to me at a time when you do expect disinflation. The key is, are people going to take this and run with a soft landing type of narrative? 1 p.m., the U.S. is selling $23 billion of 30-year bonds. The auction yesterday of 10-year notes went fine. The auction the day before of 3-year notes went fine. 30-year is more key at a time when people are expecting the Fed to pause, and then this question of a reacceleration in inflation.
Do the same people buy the 10-year that buy the 30-year at auction, or are they different beasts?
Some of them, but there is a different audience for a whole 30 years out, and it is a smaller audience than the ones for 10-year, which is more of the benchmark note. We will be watching that, and we will be hearing the interpretations from Fed speakers who have been prolific in their comments this week. Atlantic Fed President Raphael Bostic and Philadelphia Fed President Patrick Harker.
It's just Harker and Bostic.
It's basically them. Just
we make jokes.
Right?
We make jokes about this, but John, they have a mandate, and this is the time of year where across, say, they have 5 states within their district. They've got to go out and talk to people. That's part of the act. So it's not like they don't have a speaking agency saying, "Can you do Des Moines Thursday?" They're like, they have a formal mandate to speak to the business community.
The local Chamber of Commerce.
Yeah, Rotary. It's taken seriously.
Sure.
Yeah.
We take it seriously too. I talk about these speeches all the time. You take it less
but
seriously.
I think they're over-communicating, but at the same time, they have this mandate to communicate within their districts.
Okay. Evan Brown joins us now, head of multi-asset strategist over at UBS Asset Management. Evan, the data a little bit later this morning. Do you have any reason to believe the incoming data between now and the next Fed meeting will challenge the soft landing narrative that this market has quickly embraced over the last couple of months?
Yeah, I don't think so. I mean, we're not only seeing resilience in the U.S. data, but we're really seeing a broadening out of the surprises. It's really across the board. Labor market's still resilient. Consumer confidence picking up. We know housing is in good shape. Manufacturing is hanging in, and inflation is coming down. We know it's going to happen because of shelter and used cars, and we're starting to see some progress on core services ex housing. So I think the Fed wants to pause here, and I don't know that we're going to see enough data to suggest a hike in September.
Evan, within UBS Securities analysis, do companies have pricing power?
Well, I think we're seeing some moderation in wages, outright on the aggregate level. I think what's really encouraging is last week we had that productivity data. Which was quite strong, and unit labor costs coming in lower than expected. So, that is a Goldilocks situation where people can still get paid and companies still have decent margins. So we don't see a ton of evidence to suggest that margins are compressing a great deal.
What is the rate right now to companies and business? Is it the nominal rate you're focused on, or is it some form of inflation-adjusted rate that matters for the corporate spirit that drives the stock market?
Yeah, in the end, earnings are nominal, right? So that's the bottom line. That's what we've seen over the course of the last year is that even as inflation has been high, companies have been able to push that on to consumers, and we really don't see much evidence that that's going to switch anytime soon.
There is a question, though, about whether the big tech behemoths have really kind of gotten overblown over their skis in terms of valuation, over their skis in terms of the promise of artificial intelligence and some of the other technologies. Are you in that camp, especially after what we saw yesterday with a bit of, a cooling off, jitters around the artificial intelligence story?
It's reasonable given the for there to be some consolidation in this AI story in the mega cap tech areas of the world, and so that's why we want to focus our positioning on the more cyclical areas of the market. Industrials, energy, financials. We just see more upside there. We don't want to outright short tech because this AI theme. How do we know how to price it exactly? But we want to be overweight on other areas of the market.
When you do see a consolidation in the tech sphere, at what point do you find it attractive again?
Well, we want to see a little bit of just kind of moderation in valuations and a slowdown in the pace of appreciation. As long as the earnings and the earnings outlook are coming in okay, then eventually you'll grow into those earnings. So let's see first this continued repricing of cyclicals higher, and then with some consolidation in time and perhaps in price later this year, we might think about getting more involved in the tech sector.
Evan, can I just squeeze in a question on the FX market as well? We had this conversation the previous hour on Bloomberg TV. Just why isn't the euro weaker? Evan, why isn't it weaker?
Well, I think it's because they still have an inflation problem. The ECB still has to stay hawkish. I mean, yes, European growth hasn't been great. We know that. But in the end, it's rate differentials. And rate differentials are not moving aggressively in favor of the U.S. because Europe still has a core inflation problem. We're not seeing the same progress yet that you are seeing in the U.S. And also, there's been a decent negative correlation between risk assets and the euro or in the dollar. So euro hangs in as long as risk appetite stays reasonably robust. And perhaps later this year we get a turn in manufacturing globally, and that can provide a little bit of support for the euro as well.
Even as China underperforms, Evan?
Yeah, I mean, I think the China story is broadly known at this point, and a lot of that bad news in China, the China growth story is priced in. So, consumer getting, even on the margin, a little bit more confidence in China. And we're seeing, the price action in European luxury, some of that today, I think, is a result of reduction in travel restrictions in China. So these marginal steps on policy, I think, can help brighten the euro story as well.
Evan Browner, UBS. Evan, thank you. China allowing group tours back to the United States and the UK. The US, Tom, has been a soft spot for earnings for the likes of LVMH. Richemont as well. You've seen that in the earnings reports. Can that turn around on that declaration of the back of this travel story in China?
We all got our stories on this. Mine is I'm in Venice, and I'm at one of the stores. I think it was Gucci. I can't remember. And there's a guy next to me with 3 cell phones.
Taking orders.
Taking orders on the cell phones. This is what we got. And that's not the punchline. The punchline is 10 feet away. There's another guy doing the same thing. And that's what's missing.
And you're being ignored at the same time.
Completely ignored for my puny little, I think it was a scarf. But yes, precisely, I was being ignored. But
you're not spending the money.
But the point here is that's really what we're talking about, is the commerce that comes from that tourism.
If you're just tuning in, welcome to the program. It is CPI Thursday. Your equity market is positive by 0.5%. Peter Cheer of Academy Securities is going to be joining us a little bit later this morning. We'll catch up with him in about 47 minutes' time. Tom, I'm with you. I get ignored in those stores all the time.
Yeah.
All the time.
Yeah, Kriti Gupta just out with a brilliant note briefing me on all the different products that are involved here. I don't know the names. But these aren't luxury. Kriti leads with these are luxury companies. And I'm like, says who? I don't think they are.
Can I tell you, it scares me when you walk into a store and there are only like 3 shirts on the rack. Like, that scares me. Because you know what I mean?
What store's there?
Like, just if you go into some sort of clothing store and they have, just 3 shirts and everything's just sparsely kind of populated with their products, but it's more just sort of like a show.
Oh, it's a look.
Case.
The stuff's out the back.
Right, but that scares me always.
Oh.
It's
What
like
drives me
precious
nuts is how you have to line up outside
prices. That is ridiculous.
I go, my guy
I don't
Andrew.
do lines. I refuse to. I don't do lines.
I refuse to. I go up, I go, is Andrew here today? And they go, yeah, he's here. Good. I need a damn bow tie. That's it.
I don't
and if
do
they
lines.
don't want to let me in, I don't go.
Make an appointment. Make an appointment.
Yeah, right.
Don't line up. Don't do that Soho thing. I hate that thing at Soho. Just can't stand that thing. Lines around the corner for a store. What's
Nixon
that about?
was president the last time I was in Soho.
Seriously?
You and I have gone for lunch there. What are you talking about?
That was Soho? I thought
Yes,
that was
it
Tribeca.
was. No.
Oh, I thought everybody wore black.
Tribeca's even further down.
No, I thought everybody was wearing black, so I thought it was Tribeca.
No, Tribeca is below Canal Tom. We were just south of Houston. Soho.
It's Houston.
Soho.
It's Houston?
It's Houston.
I didn't know that.
Soho.
It's Houston.
Capri.
This is going well. Henrietta Trays of Vader Khan is coming up from New York. This is Bloomberg.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The core of that report was the U.S. is behind in investing in self, and it's behind in paying attention to China and other competitors who have locked out green technology and other technologies that are necessary for the future. And so, yes, when you're the reserve currency of the world, you have to step lightly. But in this case, the president has chosen to step firmly in terms of strategy.
Kim Wallace there, the head of Washington policy research at 22V Research on the latest outbound investment restrictions coming out of the White House on China. Your equity market going into CPI, equity futures positive on the S&P 500 by 0.55%, Tom. We have a deal, potentially, between Tapestry and Capri Holdings.
You're all over this.
Capri's up by 58%.
I'm going to laugh every time you say it.
The latest news this morning, Tom. A deal.
It's
Tapestry's
a deal.
down 3%.
Yeah, this was rumored, I
Connection
guess,
lost.
and there it is. And it's within, can we agree that the sluggishness of most of luxury? I mean, is Michael Kors popping it in China? I don't think so. It's not like the bigger luxury brands where they're truly international. Am I right?
$8.5 billion deal, Tom, and potentially more to come based on maybe the rationale for this one. Or others going to follow?
I don't know, but today, am I right that the other luxury makers have had a nice 1-2% pop off this travel loosening rumors in China?
So basically,
it's fluid.
They're not rumors, they're changes. So there are changes around group travel abroad. They've been doing this in groups of countries over the last few months, and Lisa, the latest group includes the US and the UK. We know domestically in China, travel, tourism, great. International, not so great. We also know that based on some of these restrictions being removed on some Southeast Asian countries, that actually travel there hasn't snapped back. So let's see if tourism out of China into the United States actually does snap back as they allow these so-called group tours to return in the US.
It's part of a broader softening, though, in a lot of stances by the Chinese government as they try to shift their stance a bit to encourage growth. So it makes people feel like maybe they want to encourage more trade, maybe they want to encourage more of an outreach in order to foster a bit more momentum.
Here's the message. Stunning silhouettes. Prepare for an exhilarating style journey that defies convention. Brace yourself for a captivating, I think it's voyage is what they say.
Is this a group
voyage,
tour?
where boundaries are shattered and personal expression reaches new heights. That'll be $6,000.
Is that $6,000?
I would assume, when I'm
what is
looking
that?
at, I'm probably lowball. It's one of the fancy luxury companies preparing me for my journey with silhouettes.
Oh, so that's not a group tour. That's not a travel operator.
No, this is real luxury.
What's the brand?
It's Hermes. Stunning silhouettes from Hermes. Find the perfect match.
Bravo's sitting back for once. She's done.
But that's real luxury. They're preparing me for
wear
a
the
journey.
same thing every day. I don't
Basically,
know.
you want to sort of say Michael Kors is not real luxury.
That's what I'm saying.
Okay,
it's
done.
not. And
It's
Bloomberg
out there now.
Bloomberg Intelligence is really good on this.
Can we move on?
Okay.
The media bundles them all together. We don't
Coaches
do
and
that.
either.
Neither does
No.
Henrietta Trays.
Okay.
Henrietta Trays, Economic Policy Director, Research at Veda Partners, joins us right now. We talked to Kim Wallace earlier, which is great because you got legit international economics there. And with Henrietta Trays, you've got piercing domestic policy analysis. Excuse me. Henrietta, what do the Democrats do on Capitol Hill to advance Bidenomics?
Well, first of all, let me just say I wish I'd dressed better for this segment because I am just beyond at Hermes, I think we're calling it now. So what are the Democrats doing to advance Bidenomics? I mean, I think right now what you're seeing is them canvassing across the country and really watching to see, most importantly, who is coming out in the Republican Party on the Senate candidate side and how they can run an economic agenda against them. So far, it's turning out to be pretty easy, and they don't even really have to focus on economics yet, as the votes in Ohio earlier this week showed. They can talk about abortion issues and get the turnout to be through the roof. They can run against Carrie Lake, it looks like, in Arizona, which is going to be sort of a Trump versus Biden and sort of mainstream politics. So the Bidenomics message is something they're trying to get out there, but they haven't had to really yet.
When you're wearing your Hermes in all the bars of Capital City and you're getting pulsed up here for the debates, the primaries, the election, Henrietta Trey's, the phrase, "it's the economy, stupid," I've never agreed with. Is it the culture war, stupid? Is that really where we're heading?
You know what it is? It's abortion, stupid. Do not come for abortion. I mean, Roe v. Wade and the Dobbs decision was the worst thing Republicans could ever have done. They woke up a beast. It is all age brackets. It is a turnout machine, and they're losing hand over foot. And I don't see any way that that's going to change, especially since Republicans keep poking the bear. So I think that's really the message. It's not the economy. It's abortion.
That message on the national stage isn't going down well. What about in the primaries, Henrietta? What do you expect to hear in the debates later this month?
Well, the debates this month are obviously all going to be on the Republican side. And I think Ron DeSantis is the one that every candidate is going to try to beat because Trump may or may not show up. If Trump is not on the dais for those debates, you're going to see Ron DeSantis just get slammed by every single candidate, from Nikki Haley to Tim Scott, on down to Mike Pence and Chris Christie. They will bring up Trump occasionally, but the person to beat will be Ron DeSantis. He's already tanking in the polls. He was at 30% at the beginning of this year. Now he's below 15. That is a death spiral. Campaign shakeups, etc. I have a friend ask if we're going to have a watch party for the November 8th DeSantis Newsom debate. And the question is more, is he still going to be one of the front runners in the race after these campaigns and after the debates at the primary side? I mean, their position on abortion is just as far to the right as you can get, and they just drive each other further, which alienates the entire general election base.
So if it isn't Ron DeSantis, who is the front runner? Is it going to be Tim Scott? Is it going to be someone who's not even thrown their hat in the ring yet, like Glenn Youngkin?
I think so, Lisa. I mean, there is a deadline of November 16th to get on the ballot in Nevada. And I think that that's a key deadline to look for. I think the money that has gone to Ron DeSantis could easily start flowing to another candidate. I do agree that Tim Scott is the next most likely, but he polls at 3%. So really, Glenn Youngkin or any of the other governors could step in. Sununu, I know you is a frequent guest on your show, and I'd be interested to see whether or not he decides to change his mind in the wake of the 4 indictments, or 3 now, but 4 to be coming against Trump, and DeSantis maybe not being the second runner-up.
There's been a belief construct, Henrietta, which you have studied for years, going way, way back, that the United States of America will always grow itself out of its debt troubles. Is that shaken right now? Is that foundational belief shaken?
I don't think so, because the appetite globally for debt just keeps expanding, and I don't think that's a U.S.-specific problem. And perhaps, to be more honest about my answer, Tom, I don't see any lawmakers sincerely putting in the effort to reduce the deficit. So I don't think that debt is something that they are really going to look in the mirror and say, hey, maybe we shouldn't extend the 2017 tax cuts for individuals beyond 2026. They're going to. They always do. We saw that movie in 2010 and again in 2012. It's going to ramp up the deficit substantially, $2 trillion just for those tax provisions. And I don't see any real conversation until we get into a maybe untenable place with Social Security.
Henrietta, I want to finish on China, if we can. The Biden administration, as you know, have put out their outbound investment order. The president has signed that. Here's the question for me. It's super narrow. China says we're disappointed. I'm trying to work out if it's just to say, A, we're doing something, and B, we're disappointed, but actually nothing really changes here. Is this just for public consumption, or is this meaningful?
You know, it's such an interesting question, and I was actually thinking about this before I came on the air. Last week, Lisa, and y'all, we were talking about the Fitch downgrade. And one of the questions you asked was, is the business community responding to what Congress is doing, what the administration is doing on the debt, to bring in Tom's question? And what's interesting about this investment executive order is that the business community is already ahead of it. If y'all had a great chart yesterday, I guess, on venture capital in China and how it's declined since the COVID era. It is a precipitous rise after 2019 and an immediate fall. And that's on the venture capital side, obviously with Sequoia, but you probably get in the same kind of thing in the data on business side as well, where you have the Russia sanctions, export control restrictions. To sort of get to that question, the business community might not be afraid of Congress and what it's legislating, and maybe not this executive order, but for damn sure they're focused on the Bureau of Industry and Security and the Treasury and the IRS and the efforts that they're going through to put sanctions, export control restrictions, investments restrictions. The entity list is going to be updated. Those are real, tangible meat and potatoes things that businesses have to respond to. And I think they are working, maybe just better than the timing on an EO.
Henrietta, thank you. Henrietta Trace there of Vader Partners from New York. Inflation data an hour away.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Two-day losing streak on the S&P 500 going into CPI 60 minutes away. In the equity market, equity futures positive here by 0.5%. On the Nasdaq, we're up by 0.6%. In the bond market, the 10-year hasn't had a close below 4%. all month. The month is young, I know, it's only August 10th, but still, in at around 4% again on a 10-year. Yields going nowhere. On a 2-year, 479.75, yields lower by a single basis point. On a 30-year, look out for supply a little bit later. Some more 30-year bonds coming to market later on this afternoon. Your 30-year yield, 417.31. Talked lots about the FX market. Let's finish on the euro. Quick check of what's happening in G10. The dollar weaker here against the stronger euro. The euro against the dollar here, Tom, 110.25. Positive on that currency pair by 0.46%.
And not to waste time here, but euro yen, I think yen dynamics here. Bruce Kasman was just brilliant on this earlier, and the idea of you triangulate three currencies, not a currency pair, but a currency triangle. Take out the dollar, you got euro yen. He was focused on euros. You've been focused on the mystery of why euro's at 110 versus, say, at a 105. But the bottom line is the screen, the Bloomberg terminal's telling me we're at a tip point on euro yen.
The euro is stronger this morning. The dollar is weaker against everything at G10, with the exception of the Japanese yen. Under surveillance this morning, US CPI data due out in about an hour from now. Investors looking for further signs of disinflation ahead of the Federal Reserve's September meeting. Are you getting any disinflation in New York City? New York City apartment hunters could be reaching their limit. Rents in Manhattan, Brooklyn, Queens hitting new highs in July, but leasing volumes declining, signaling the renters may have had enough. I can tell you we'd had enough a long time ago. The median rent now in Manhattan, $4,400. Elisa, that's up for 2.3% from June. Rents jumping 11% in Brooklyn, $3,950. Just amazing.
I love how personal this story is for you. Not that I love that you're, struggling with the prices, but rather that, this is where you gravitate toward, and then you're going to start in, if I could only go back in time and lock in low interest rates and buy a home and be paid to buy a home, that's going to be really important. And this is where we're at. At what point do you have, yes, pushback, fewer leases, but at the same time, they're still paying the prices, and the price is still creeping a bit higher?
Tom, $4,400.
Yeah,
for an apartment in New York City.
What I take, they do. Jonathan Miller does a great job on this at Miller Samuel and all that. But I wish in the article they equated that to how much money do you have to make to buy that studio? The place I live, the 6th floor walk up I live on, is a studio popping at $4,200 right now, which is basically a closet with a window. And the basic idea to me here, as I mentioned the other day, is the economist Carrie Bradshaw index. Carrie Bradshaw was an economist at LSE, and Carrie Bradshaw index is what is the median wage?
Sure.
Yeah, she's exactly.
Okay, let's go there. How did Carrie Bradshaw afford that apartment and all those shoes?
It
made no sense at all.
Yeah.
It made no sense
it's
at all.
It's the fantasy of it.
She was a columnist for some random New York paper.
She was good.
And she was buying thousands of dollars worth of clothes every month.
John,
stop asking questions. These aren't the point.
She refied the studio apartment off the Manolo Blahniks. I mean, that's how she did it.
Carrie was a terrible human being. She really was terrible. It's amazing that people are starting to figure this out 20 years later.
Stay with us. Don't go away.
Yeah, exactly. How do you really feel? What was the biggest, most offensive thing that she did?
When her friend got married, and she came out and she put that post-it note on top of her hand because she'd had a tough go of it with a new boyfriend. Come on, they got engaged and she wasn't happy for them. Dreadful.
Hot take.
I'll tell you what I really think.
No kidding.
All right, another time. Let's get to this really important story developing overnight.
No idea what you're talking about.
In Ecuador, presidential candidate Fernando Villavicencio assassinated less than 2 weeks before the country's elections. He was shot while leaving a rally. The government declaring a 60-day state of emergency. This individual, Lisa, you might be familiar with him, well known for unveiling corruption in government in his country. Of course, death threats coming from various parts of the country, including the mafia. I was looking at some of the death rates across Latin America. In Ecuador, it is shocking how much that's gone up.
They have more homicides per capita now than Colombia, which traditionally had the serious cocaine problems and some of the cartels there. This candidate was a longtime journalist who really said he was going to crack down on these cartels. Yes, he got death threats, but he said, no, we need to repeat what some of the other Latin American countries are doing where they really crack down because the amount of the assembly of the cocaine cartel has just been out of control.
My amateur take on this with a quick read, and I defer to people like Shannon O'Neill at Council on Foreign Relations and others, is I'd watch El Salvador. It's interesting to see the hot spots within always troubled South America, El Salvador, the others, the mafias, the cartels, whatever it is. And the solution in El Salvador is basically almost like a hungry John Eastern European solution. Let's get tough.
And the president is the most popular in Latin America for rounding up cartels. And people say he's very authoritarian, but this is what people are now going to look for in the hard line that you might see the shift in Ecuador in response to this.
John, I have no idea, John, where Europe comes from this, but I know in America we are so biased by our childhoods of looking south across the Caribbean to South America, that I don't think I think clearly on this other than the tragedy of a journalist gunned down today in Ecuador.
I think we're all familiar internationally, Tom, with Colombia and Peru being hubs for cocaine production. Ecuador sandwiched in between, that wasn't really part of the conversation until recently. I was going through our story this morning, and thanks to the desk overnight for putting this together, the murder rate there soaring by more than 300% over the last 5 years. It's got dangerous really quickly.
Yeah, I mean, I just think it's, really serious point. We'll have full coverage on this through the day as well and into the weekend as Ecuador adjusts to an assassination. Right now, joining us, Megan Robson, head of U.S. credit strategy at BNP Paribas. And that's a really, really interesting fixed income position because BNP Paribas has been outstanding over 20 years of a measured view of economic growth and how the markets would react to that. How do you dovetail Carl Riccadonna's world and an inherent BNP Paribas economic caution into the fixed income market? How do you adapt to that?
Well, thanks for having me. So we expect growth to slow, and we're expecting, we are in a growth deceleration. Heading into CPI today, we expect that inflation will be low enough or good enough for the Fed to be on pause. And credit markets are pricing in only the positives around that. So if you look at credit spreads, we hit new tights at the end of July. Credit is pricing in all of the benefits of lower inflation without some of the risks of how that process plays out, or that process potentially takes longer to play out. So for example, during second quarter, revenue growth typically tracks very closely with CPI. We've seen revenue growth now hit 1 to 3%. So we're approaching that 0% level of revenue growth.
This is the BNP Paribas heritage. I'm going to go to Marty Fritzen, the great default guy on this. Are we underplaying credit risk? And I don't mean gloomy high yield credit risk, but even credit nuance in the middle of the investment grade area.
I think investment grade, so growth has surprised to the upside. That is undoubtedly a positive. And I think that we are seeing deterioration in broad fundamentals, but for investment grade, fundamentals are still generally pretty healthy. So as an example, a year ago, interest coverage was 13 times for the investment grade market. That has come down over the last year to about 11 times, but still quite healthy. The places where we're more worried and where we have seen distress played out are the most interest rate sensitive parts of the market. So two examples where we've seen defaults start to rise. One is small and medium business enterprises. So companies that don't necessarily have publicly traded credit, but are public companies, are private companies, very small, and those are most sensitive to rates. So it's not surprising to see that bankruptcy filings have climbed higher there. And then also in the leveraged loan market. So leveraged loans, obviously floating rate exposure. Over the last 3 months, and I know, Tom, you like to follow the 3-month statistics on an annualized basis.
Nailed it.
If you take the 3-month loan default rate and annualize that, you get to a 5.5 or 6%
There's
level.
a gloom we need.
Well, is the public market less important than it used to be? Is sort of the metric that we look at when we look at spreads less relevant to the reality on the ground for all of the big investment firms that are increasingly moving private?
It's a great question. So I think that private credit is definitely going to play a role in this cycle, and things will be different. A simple but I think very relevant framework to sort of identify problems in any cycle is to follow the debt growth. And if you look at debt growth in private markets, it has outsized that in public markets, and it should point to there being issues there. There has been growth in public markets as well, but not as extreme. So I don't think that private markets will be immune from this cycle, and we will see some problems in that area as well.
Do you think that it dulls the sort of tea leaf reputation that credit used to have, that it was the canary in the coal mine, because there is this huge buffer of debt that's in the shadows that you can't really see engage in real time, and that kind of underpins some of the credit quality in the more established companies that we trade publicly? In other words, it's not a leading indicator anymore, is it?
So spreads are certainly not a leading indicator. As we hit the tights in high yield spreads, we're trading below 400 basis points. That market would be telling you there's no problems ahead. But I do think there's other areas of credit in the public market that are signaling a recession or problem. So if you look at the primary market, the very low share of CCC issuance is telling you, and is in line with what you've typically seen in a downturn. Another example would be the rise in secured bond issuance in the high yield market. So I do think public markets are telling you signals, but it's not the typical sort of CCC, very gradual widening from the rest of the market.
Sometimes we become desensitized by news elsewhere, just hearing it on a continuous basis. But should we be worried about what's happening in China with property developers?
So China, we have seen stress in China over the last few years. I think that from a demand perspective, it is going to impact our growth outlook and our growth trajectory. We're already in a deceleration, so I do think that following China will be important, and also from the perspective of stimulus and how much liquidity is pumped into the system, it will be very relevant for our demand and liquidity outlook.
Megan, thank you. Megan Robson there, BNP Paribas on the credit market. Lisa, it just seems that property developer after property developer getting into a little bit more trouble over in China.
Yeah, the latest being downgraded to what, CCC? By one of the rating agencies this morning.
Just
after
cut
as they don't pay their interest payment. They're in the 30-day grace period. There's going to be evidently some sort of meeting that China's holding with some of the property developers to try to shore up something. What does that look like?
I want to be clear to our audience that we don't equate this to what we see in CRE in New York or other major U.S. cities. This is a uniquely China, massive development marketing kind of company like Evergrande. It's been widely anticipated over the last number of days.
If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.5%. Counting you down to the CPI report. We've got a clock up. We do. Look at that, TK. 47 minutes away.
I thought that was Harry Kane's clock to when he announces he's going to
Now he cares.
We haven't had an official announcement, have we?
No, we haven't. I thought that was. I thought you put that up just to bust my
reporting coming out of
chops.
the Athletic that the club has accepted.
What does Sun do? I mean, the Sun's coming down the field and there's no Harry. I mean, how does that work?
Sun is going to be upset because he misses Harry.
So he'll leave.
Sweet.
Is that
No, I
the
don't know if he's going to leave. I've got no idea.
What have they done?
Leave.
They're like the Red Sox last year. I get all these teams. I can't keep up.
Tom, you support a terrible team.
Thank you. See the love here?
Which one? Did you say that
Who do
Red
you
Sox?
support in English football?
I'm going to take the fifth on that one.
You're supposed to say PSG. You work for BNP Paribas. Every answer's
Paris
PSG.
Saint-Germain. That's
Thank
true.
you.
That's true.
See?
Yeah.
See?
You okay
Did you
there?
say C?
He's learning.
Did you say C?
No, I think he meant S-E-E.
Oh.
Like C.
Sorry, I just
C.
thought, I don't know.
You want to talk about
Things are going
tourism?
off the rails.
You want to talk about tourism? This
Sure.
hotel I
Let's
stayed
talk
in
about
Paris
tourism. Why not?
is
Let
lovely.
me tell you.
I called the hotel the other day, and the guy goes, "Mr. King, you literally can't walk down the street. There's so many people."
Where?
Paris.
Oh, right.
You
okay.
can't. You know, it's a narrow street in the Seine.
Was he trying not to get you to come?
It's like
He sold out. He doesn't care.
China. John, I just looked at the trip to Shanghai. You ready? United Airways, two
How much?
people. It's $40,000 with the taxes.
I'm sorry. What?
40.
40.
For one
That's
ticket?
what it costs to come
Where
out of Newark to
is that
PVG.
for the whole plane?
No, that's two people sitting in business class.
Two tickets.
Stop it. 20K each.
$39,000. That's what it says. Two people.
That's insane.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
Great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We think that the market's fair valued where we are right now. I still think that there's some risk in this market in the sense that we think you're going to still see a mild recession unfolding. And right now, I think everybody's just getting overly optimistic on both the equity market and the economy. And I don't think that's warranted because, like I said, there are some signs that we're looking at that still point to a recession by the end of this year.
That was Larry Adam, the Raymond James CIO, on this equity market.
He was on fire yesterday.
Going into some important inflation data a little bit later this morning. Expected to show further signs of disinflation beneath the surface going into the Fed's meeting at the end of September and just before the Jackson Hole Symposium, the little get-together of Fed speakers, economists, and people like us. Equity futures on the S&P 500 are just about positive into all of that by 0.4%. The 10-year yield, as it has been over the last couple of weeks, Tom, in and around 4%, and basically unchanged on the day. Bit of dollar weakness out there against G10, the euro firmer here by 0.5%, 110.23, Tom.
Yeah, well, there it is. Are we getting used to 4%? I'm sort of finally getting used to it.
2 weeks of it.
It's been 2 weeks of it, and I'm sort of getting used to it. It's like a look back to
Had a sniff of 420 and then back to weight, didn't it?
Yeah, I mean, that's where we are. We get the clock up, 42 minutes, 41 seconds to this inflation report. It's important. Is it important, John, for the banks? What do you think? I think they care.
I think they care.
I think they care big time.
They responded negatively to the downgrade they had from Moody's earlier this week, Tom. 10 small and medium-sized banks. We moved on pretty quickly.
Big banks.
From the woes of spring. And
M&T.
we're going to be seeing if some of those issues come back, Tom, make a comeback.
We're going to link an inflation here. We've done a search over the weekend. Bramah was in charge of the search for the $100 lobster roll. It's out there somewhere, probably up the shores of Maine. Joining us now to brief us on the inflation within $100 lobster rolls is Gerard Cassidy, head of U.S. Bank Equity Strategy, RBC Capital Markets, iconic with New England banking and across from sea to shining sea. Is there a $100 lobster roll out there?
Not yet, Tom. Let's hope not. But, $35 to $50 lobster rolls. But I'll take you to Port Clyde. We'll get them for a lot cheaper than that.
I got 8 ways to go. I'm going to be quick because John and Lisa got lined up a bunch of questions. I was thunderstruck at a credit adjustment for M&T Financial. That's like fighting words for the wonderful Mr. Willens, the late Robert Willens, who made that wonderful, wonderful bank. Were you surprised that M&T was bundled in?
Yes, we were, because M&T is one of the strongest, to your point, when Bob Wilmers ran the bank. The underwriting credit culture there is unsurpassed. But that being said, when you compare them to their peers, they were a notch above their peers in terms of credit ratings, but they should have been because they've got the track record of showing everybody they do not blow up in credit cycles.
Gerard, downgrades at Moody's. Let's talk about them. 3 issues. High funding costs, 1. Number 2, potential regulatory capital weaknesses. And 3, rising risk tied to commercial real estate. Of those 3 points, all well known, what's the number 1 issue we have to focus on?
John, I'm glad you say well known, and that was the surprise with the Moody's news, is that it was kind of late. If they did this back in November or December, you could understand it, but this was all well known, to your point. But if the Fed reaches terminal rate, let's say out in Jackson Hole, that's the last rate increase, the rising deposit issues they have identified go away because deposit costs about 6 months after the terminal rate is reached, stop going up. The capital, if you're a creditor, having the banks carry more capital, that's a positive positive. But so your third point is the one that we got to watch, which is real estate.
Have things stabilized for the small and medium-sized banks just in terms of what they've got to pay up to attract deposits?
Yes. In fact, every Friday, you might be familiar, they have the H8 data that comes out from the Fed. And if you look at the deposit levels for the smaller banks for the last 8 to 10 weeks, it's been flat. Where the deposits are leaving is the bigger banks because of QT. That's where we're seeing it. So for the smaller banks, they're not having to chase the deposit rates as much as they did right after Silicon Valley.
That said, perhaps it's getting more difficult for them to pay the rates that they need to attract the deposits, considering they've got a lot of competition. You're seeing an increasing number of consumer loan books sold to private equity and private debt companies. You're seeing this sort of shift to be more cautious. Do you think that perhaps some of these downgrades turned up the volume, to use John's language, on some issues that have not gone away, even though the market's forgotten about them?
Lisa, I think you're right. Turned up the volume is a good term, and I think I think you guys are right that it did turn up the volume. But that being said, I would still point out that the credit quality for the industry is remarkably strong. And if you look at the second quarter results, we did see credit losses creep up. You know, they're normalizing. As Jamie Dimon at J.P. Morgan would tell you, his credit card net charge-offs are still below normal and well below pre-pandemic levels. And credit non-performing assets, delinquent loans for the industry in the quarter, or the top 20 banks, I should say, were flat to down. So credit is still strong.
So do you think that the commercial real estate issues are not sufficient to justify some of these moves now?
I would say that in certain cases it is, and that's what M&T, why they were identified. Out of the top 20 banks, they have the largest exposure to commercial real estate at around 24% of total loans, but still manageable. Most of our biggest banks are in the mid-teens, and when it comes to office commercial real estate, that's the CMBS market where the problem, that's private, that's the shadow banking industry, not the big banks.
It's a Thursday in August. We don't do gossip, but it's a Thursday in August, so let's go there. You have decades of experience. How do they transfer leadership at these banks? We've got a James Gorman story today about the churning at Morgan Stanley, all the upset at Goldman Sachs, Montag coming from Bank of America back to his Goldman Sachs, and on and on. The uncertainties of what happens at JP Morgan. How do you monitor that quarter to quarter?
Tom, it's challenging because we don't have very good insights to the inner workings of those executive suites on what the politics are and what the maneuvering is going on. Plus, two of the people you've identified, Morgan Stanley's Gorman and JP Morgan's Dimon, of course, have had incredible success over the last 10 to 12 years. So filling those shoes is going to be very challenging for whoever those people are.
Can you say the same thing about Solomon at Goldman?
He's had a challenge. He's struggling. He's been struggling. So he has not had the success.
That's that New England understatement. The answer.
It's getting tough, isn't it?
Yes, it is, John.
You're seeing partners leave, high-profile people on the research side of things leave. Jeff Curry earlier this week, I don't know what's behind that decision, but it starts to mount. Do you think we're at that point where we're thinking about new leadership?
They certainly, that discussion has to, again, we don't have inner knowledge of it, but you have to believe at the board level that's probably a discussion point in their meetings. Again, it's just a natural discussion point because of what's been happening.
How badly have they been doing relative to Morgan Stanley? I mean, do you think it's justified, or do you think that it's just noise that's overwhelmed the narrative and overwhelmed the reality?
That's an interesting question because the actual stock performance, though it's lagged Morgan Stanley, people have still made money under Solomon. He's, his valuation, his tangible book value per share growth has been impressive, but it's not as good as Morgan Stanley. Morgan Stanley had the big upgrade in valuation at the beginning of the pandemic that Goldman did not get.
My theme for this year, 2023, the great zombie roll-up. Forget about the zombie banks, but just in general, with the new interest rate structure we have, which is the regional, super regional, where Gerard Cassidy wakes up and goes, you got to be kidding me. This thing's got to be put out of its misery.
Yeah, so far, Tom, we're very fortunate that after what happened in the spring, the wounded soldier that they just took off the battlefield was PacWest in that unique deal.
Hey, who's next? I got to make some money here. I got to buy the lobster roll.
So I think on the downside, it's hard to identify. In all seriousness, it's very hard to identify them. We're a well-capitalized industry with low credit problems because in our old days when you and I were young men,
if we went on Mike, you'd have 3 names for me. Can you give? Farrell wants a name. Come on, we need a name.
Well, on the long side, you certainly want to own M&T. guarantee. I mean, I would certainly be stepping up to that. And then, of course, Brian Moynihan's bank, Bank America, is another one.
You always love BFA.
Yes.
I wanted to build on Bramo's question, actually. Do you sense it's personal when it comes to David Solomon, the coverage of him? I don't know him personally. I've interviewed him when we've spoken. He's been very pleasant. But do you get the sense that it's personal when it comes to David Solomon and some of the coverage he gets?
I think it could be because his lifestyle was a little different than the other CEOs, as you know, at the outset. So there could be some of that there. I've like you, John. I don't know him very well, but the times I've met him, I've been impressed. He's very engaging. I enjoyed the time talking to him.
John, it's a brilliant question, and the way I would put it, and I would give you a story with Gerard Cassidy here, it's cultural.
Yeah.
One day, Gerard Cassidy and I on St. Patrick's Day, we're with 1,200 people at some Bank of New England or whatever. Gerard's is such a rock star. He's within reach where when they're throwing bagels and donut rolls at the stage, Cassidy's getting hit. I'm back in the cheap seats because I'm not Gerard Cassidy. But it was cultural about the Irish banks coming over and buying in. And this is Brian Moynihan way back, Bank of Boston or even Fleet Bank before that. And that it's hugely cultural within the business. That's underplayed by the media.
John, you're right.
Good to see you.
John, Lisa, Tom, thank you very much.
Thanks for being in with us. Gerard Cassidy of RBC Capital Markets. Can't believe how much that lobster roll costs.
There's one that's $160.
What's ridiculous?
$160.
Yeah.
But what's ridiculous, John, is the line is 6 blocks long.
$160.
Yeah, I'll share this with you.
How many lobsters are in
Taste of Maine.
Taste of Maine's expensive.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
this is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We think there's going to be some choppiness here. We think we're going to see a pullback in the fourth quarter of this year.
You tend to have 3 to 4, 5% pullbacks in a given year. We've had one this year. So I think it's time to have one.
I think the second half of the year, inflation ticks higher. I think we finished the year probably closer to 4% on headline CPI.
We are in a disinflationary trend.
The challenge will be if the Fed does indeed remain higher for longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A busy day, a countdown clock here at the 8 o'clock hour, 29 minutes, 18, 17, 16. To a statement on inflation in America. And John, it's a complex story.
We want further signs of disinflation, Tom. We'll be looking month over month for that, expecting that to come in at something like 0.2, in line with the previous month over month reading, and setting us up potentially for a pause at the Federal Reserve on September 20th. Even those out there who believe inflation might reaccelerate in the back half of the year, they don't think the incoming information between now and the next Fed meeting will challenge that soft landing narrative. City's Veronica Clark has written about that coming into this print, Tom. That seems to be the view, that the data between now and then is going to show the same as it's shown over the last month or so.
It's a granularity of inflation as well. I go to the big ticket items like rent. We mentioned New York City rent earlier. John, a car dynamic as well, the food dynamic as well. But within all the granularity, there's the way the public feels, and it's separate from the Bloomberg surveillance audience.
Are American companies losing pricing power? That's a conversation we can have
That's
post-earnings.
the investment question.
JetBlue, Southwest, talking about maybe flagging demand,
Capri.
maybe cutting airfares. We'll talk about Capri a little bit later in their deal with Tapestry potentially. And then, Tom, Disney. Subs were light at Disney and they're putting prices up. Let's see how that goes. Is that tolerance there in the American economy the same way it was maybe a year or so ago?
I think you nailed it. I mean, Margie Patel and Jessica Reif Ehrlich make it very clear they don't see a problem. Lisa, I don't buy it for a minute. I think this inflation report that we're going to get in 27 minutes, 51 seconds, this inflation report is simply a statement on what American corporations can do. And there's this belief they can raise prices. I'm not sure I'm there.
I think the issue with Disney is if people are using it to babysit their kids, then they can take a 27% increase in costs, and it's probably a very cheap babysitter. But if you don't and you have it as a peripheral service, it's different. I'm just saying, theoretically. I am wondering where the bias is in markets. If we get an upside surprise, how disruptive that could be to market positioning that is preparing for a soft landing, signs of disinflation, et cetera, et cetera. In other words, how much do we end up getting a big surprise in markets, downside surprise in terms of price action, if we get signs that disinflation isn't happening quite
I'm going to fold disinflation report into the guess on nominal GDP and the guess on revenues. And John, you see it right now with Ralph. All you got to do is say Ralph. It's not like Tapestry. What's Tapestry? We don't know. Ralph, we know. Revenue flat, up slightly, constant currency. That's that revenue struggle.
Stock is down by 1.5% in the pre-market. You've mentioned that deal twice now, so let's discuss it, Tom. I believe it's an $8.5 billion deal. Tapestry going after Capri. Capri Holdings is up by 57% in the pre-market, Tom. Tapestry's down 4.7%. So what is this? Kate Spade and Coach going after Michael Kors?
Yeah, or so. I mean, Critty wrote me a note. She's a lot smarter on this than I am. And the bottom line is Tapestry buying Michael Kors, but really it's a roll-up into Michael Kors. It's sort of like the inside baseball question. I'm not informed on that, but...
You sound well informed.
I've never been in a Tapestry store. I've never been in a Michael Kors store.
It's a Tapestry store. It's a parent company, and you're humming Carole King and her Tapestry, which is fantastic.
Have you been to Coach before? You've never been, Kate Spade?
I have been in Coach because of Tom Wesselman, the great. They did a whole line of stuff with the great iconic artist Tom Wesselman, and I had to go in for that.
Wiseman do those thigh-high boots, TK. Familiar?
No, I'm not.
Equity futures. That's
Moving
a
on to the data check that will save us.
Stocks positive by 0.5%.
You're like an HR violation. You're like a rolling HR risk with me.
I'm talking about product and branding. Come on.
Come on. You mean
Yields are
James
lower
Chu?
by a couple of basis points. No, the Jimmys. Yeah, Jimmy Choo's. Yeah, sure.
They have those boots? I don't think
Jimmy
so.
Choo, you always see on sale. You always see Jimmy Choo on sale. Always.
Do you?
You know that rack at Bergdorf's? The sale rack that you get dragged into? Sale.
You mean second floor, aisle 3?
Up the skinny escalator. Yeah, well, yields are lower by a couple of basis points on a 10-year. It's needed. Tom,
John and I go shopping there all the time.
398.58 on a 10-year.
We're going to continue here. It's seriously 25 minutes away from an important inflation report, and it is wonderful and honor to have Peter Shear with us, head of macro strategy at Academy Securities. They take a geopolitics view and fold it into the investment view forward. This inflation report, how does it affect our investments in general?
I think it's going to be a relatively minor influence on markets in the short term. I think right now the Fed is waiting for a lot of data to come in. They're looking at inflation. They're going to look at jobs. I think they've really changed their outlook, right? 6 months ago, they were still looking for any excuse to hike. Now I think they're being a little bit more cautious. So I think every little bit of data, the market reaction is going to be muted. I think we've set ourselves up to fade on a little spike in inflation. And then I think people buy that dip.
To Lisa's point, what kind of upside surprise do you need on CPI to reintroduce the risk that this Fed might go again in September?
You know, I think you need to see something shocking gets you back above 4% or something. And again, I think the media, the narrative about the public doesn't care as much about 3% or 4% inflation. 5, 6, 7, 8%. Yeah, you can get a lot of momentum and people can talk about it. But I think, you know, at this level, I think it's kind of status quo for the Fed.
Do you think that it matters that there has been an increase in the longer term inflation pricing in markets as we get the sense, as the Fed gets comfortable with the idea of staying on hold?
Yeah, and I think that makes sense. So our longer term outlook has really been that we're going to be in this 3 to 5% inflation environment for the next 3 to 5 years. And a lot of that, whether you want to call it geopolitical inflation, onshoring inflation, it's part of how American companies are going to do business, right? They are going to change where they're producing, how they're producing, what sources of, you know, their supply chains look like. The government's doing that. So I think that's going to keep inflation above that 2% for a period of time. But I think we can live in that 3 to 5%, especially if it really is around this kind of security of your supply chain.
Is that what we've been feeling over the past couple of weeks? That essentially markets are getting comfortable with the idea that the Fed is going to let inflation sit around 2.5% to 3% for a long period of time, that could be okay, benign for a lot of the companies that are reporting earnings, and bond markets are already priced there. Is that basically what we're seeing the new narrative is developing?
Yeah, I think that's the narrative that's developing, and I think the new one beyond that's going to be, what does China do to combat this, right? You know, everyone was talking earlier this year about the China reopening trade. I think clearly that's a misery, right? It's just not happening. I never thought it was really going to happen, but China is no longer going to be this big factory for the U.S., so that's changed in China. The Chinese consumer is not the American consumer, and that's especially true with the problems that are going in real estate. So our view is that China, and this is, I think, something that's not yet being priced in, is as we're doing this reshoring, as we're figuring this out, I think the next stage in this kind of friction with China is China aggressively trying to sell their brands globally. And I think they're going to go after the emerging markets countries, and that's something we're not seeing. We've never really seen China as a competitor selling their brands, except for Huawei, and they had phenomenal success with Huawei. Look for that push to occur in other things, whether it's their EV makers and stuff. And I think that's going to be the narrative for the next 2-3 years, that U.S. companies are going to have to deal with competition from Chinese brands.
I got to rip up the script then because of the overlay of your shop. You have an exceptional, at Academy of Securities, you have an amazing overlay of military. We've got in the Black Sea new naval affairs with drones. They're frightening whatever side anybody's on. Bring it right over to the South China Sea, where Marcos is going after China now with the ship floating around the south. It's like out of a Stavridis novel right now. Overlay the geopolitical uncertainty around your belief in China and how American investors should respond.
So I think there's going to be ongoing friction with China. I think Chinese companies may do well selling some of their products, particularly in emerging markets. I would not touch Chinese stocks because of this friction. And probably 2 years ago, I think we were relatively early in talking to companies about when they were thinking about reshoring or onshoring or moving out of China. we talked about not going into Southeast Asia, and that was, I think, the natural reaction before the Russian invasion. I think people have become wise to that. They're sitting there and seeing the Chinese Navy expand, right? They went from what we call this brown water Navy, which is coastal, to blue water Navy, so they can project their power. We kept telling them not to build South Island Sea, and they kept building up those islands, right? They struck a deal with the Solomon Islands. Solomon Islands has now, since then, stopped at least one U.S. Coast Guard ship and a UK naval vessel from boarding in Solomon Islands. So you see this projection of power, and I think we're really going to have to see the U.S. has to concentrate on North and South America, develop better and stronger relationships with South America in particular, where we have the geographic proximity to them. China has some inroads, and we're going to have to figure out what to do with Africa. It's such a burgeoning economy, and we just wrote about this. One of our journalists pointed out the other day when there was a coup in Niger, people didn't realize the people in the protesting were shouting, "Long live Putin," right? So Russia does have power in Africa, so that's where we're going to have to concentrate our global focus, South America and Africa.
Can we just finish on the weakness within China right now? 10 years ago, if you came up with a bearish thesis around China, it sounded something like this. Local government debt was piling up. It was piling up because they were trying to hit growth targets and please central Beijing. And what you were seeing was a property market bubble forming. And ultimately, people would say, in the end, they're going to have to deleverage. Property prices are going down, developers will go bust, and this economy will sink. What are we seeing develop now? We're seeing property developers go down, local government struggling to stimulate the economy to get GDP to where China would like it to be, and property prices are starting to come with it. And yet we're just shrugging our shoulders. Isn't this the ultimate bearish thesis that was laid out a decade ago, playing out before our eyes?
Yeah, I think it is. And I think that's why China's reaction is going to have to be, how do they sell their goods, the things that they're making, probably with stolen IP, into the rest of the world, right? If you can't figure out what you're doing internally, look at that projection of power. And don't forget, they've set up all these Belt and Road initiatives. They have access to ports. They have big deficits to a lot of the autocratic resource-rich nations. So that's the place that they're going to start trying to sell their goods, right? If you've got this internal problem that they've been working on for 2 or 3 years that's failing, well, you can either keep trying to fix what's not fixable, or you expand. And that's why I think they're going to be aggressive players on the global scene. And if you think about it, think about what China does even politically outside of the country. 2-3 years ago, you never really heard them doing much. They're getting involved with Saudi. They're helping Saudi strike a deal with Iran. They're the only ones really talking to both Russia and Ukraine. So I think that's going to be the shift in how China tries to deal with this. And we're all sitting there, oh, you're collapsing, this sucks internally. Well, guess what? They're not going to take this line down, I don't believe, and that's going to be their push.
And they haven't. Pete, thank you. Peter Chair of Academy Securities, really thoughtful stuff. Seeing China at the epicenter of foreign policy issues has been pretty remarkable, incredible, Lisa, over the last year or so.
It speaks for the desire for some sort of global influence, and it raises a question of what that does to some of the U.S. companies globally if they have to compete.
We've always given the policymaker in China the benefit of doubt, and I think we continue to give them the benefit of doubt currently, and we'll see how it develops. If you are just tuning in, welcome to the program. The S&P 500 positive here by 0.5%. As we count you down to the CPI report, 17 minutes away, the bond market rallying just a touch here. Yields are lower by 3 basis points. We'll bring you that report and then bring Neil Dutter of Renmac to you, Tom. That conversation coming up a little bit later.
Really curious about his durability of a 4% statistic right now from Atlanta GDP. Michael McKee was brilliant yesterday, John, on how that's just a current number and it will amend as we go through the quarter. But I wonder if Dutta's pathway is from 4.1% down to 3.x% or down to 2.x%. He's the optimist out there. It'll be interesting to see.
He's pointed to housing so many times. Housing's still doing all right, Lisa, in certain parts, bouncing back. We've talked about rentals. Are we starting to see the limits of our tolerance for higher prices in this country, particularly here in New York City, as volumes start to drop, even though prices are still climbing?
You know, this has been the issue, but it's been an inventory issue. I mean, that's been the problem, is that just aren't the homes. And if you start building them, maybe. Can I just say that this has got to be the least important CPI report ever, based on how people are talking about it, that it basically doesn't matter. Am I wrong?
That's why my radar's up.
That's based on what they expect.
Correct.
Because they expect further signs of disinflation. And there's extreme comfort that that will continue through summer. Yeah. We'll find out in 20 minutes if that's misplaced or not.
Extreme comfort. I think that's
an uncomfortable calm.
I didn't know who Carrie Bradshaw was.
Hey?
Twitter's informing me who Carrie Bradshaw was.
Oh, yeah.
I did not know.
I've had a lot of feedback about that.
Yeah.
Charlotte York was where it's at. That's official, right? And it doesn't matter, all right? From New York, this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Disney's a great example, as they felt they had room to raise prices, and I think they'll be successful in retaining those price increases. And that's one of the reasons why we've seen corporate margins really maintain themselves. A lot of people thought this year we'd see margins really get squeezed, but companies have been able to pass on price increases.
Marky Patel there, Senior Portfolio Manager at Allspring Global Investments, going into the CPI report, which is 13 minutes away, looking for further signs of disinflation in the American economy. The price action shaping up as follows, going into all of that. We look like this in the equity market. Positive here by 0.6% on the S&P 500. In the bond market, yields a little bit lower by 2 or 3 basis points. Big focus on the earnings, as always. Yesterday, after the close, we had earnings from Disney, Tom, the Walt Disney Company. The earnings better than expected, the revenue not so much. Cost cutting
there
is where it's at, partly due to the strikes, and I think that's gifting the stock a rally of 1.4%. But going forward from here, prices are going up for streaming, and subs were disappointing.
I defer to Paul Sweeney, Jessica Reif-Ehrlich, Michael Nathanson, Rich Greenfield, everybody else on this. They can tell me all the ratios they want. It doesn't matter. It's a busted business plan, and Mr. Iger knows that, and he's got to fix it.
How's he going to fix it?
Well, I thought Jessica was very good about that there's a huge mystery. He's bringing in some ex-guys to consult in and all that, but it's not the same business. You sit there at a restaurant in L.A. and go, which movie are we going to do next? Is that the formula? I think so.
Which Marvel movie comes next?
Well, yeah, I don't have any wisdom on that. You know, they didn't do Barbie. I know that.
Well, things are getting sold. I think we know that. It's just what's getting sold.
To who?
Lisa, that we need to figure out. Well, precisely.
That's been the issue. But at the same time, if you are better, bigger, that is sort of the theme. Are we seeing that it is better to be bigger? And if so, maybe Apple gets a little bigger. Maybe one of the other streaming networks gets a little bigger. But it's not Disney because they don't have the critical mass.
We're going to slip this in right now before we go to inflation here. Michael McKee is on standby. He's in New York, and we'll go beneath the headline data here at 8:30, about 11 minutes away. But we really wanted to talk about this iconic blue chip stock of another time and place that's become a single-digit marvel. Geetha Ranganathan is expert on Disney, on media. She is with and owns Bloomberg Intelligence. Geetha, I was thunderstruck by the McKinsey-like discussion yesterday. Are they talking security analysis, or are they going into consultants to blow up the company?
I don't know. It's a little bit of both, Tom. So, you know, we obviously had Bob Iger on the call saying that still all options are on the table when it comes to the beleaguered TV assets. So you have, you know, this wonderful portfolio of assets, some of them doing extremely well, like the parks business, which will bring in about 75% of profits this year. But on the other side of the equation, you have TV, which is, you know, obviously in secular decline. You know, he has, as you mentioned, brought in Tom Staggs, Kevin Mayer to kind of look at how to go forward with that. And then you have kind of ESPN there, stuck a little bit in the middle. I don't think they necessarily want to get rid of that. You know, we already saw them do that Penn National deal. And I think it makes sense for them to kind of keep ESPN as part of that broader streaming portfolio as well. And then you have the streaming business, which is kind of very much in transition. So it's...
John, the heart of this is Craig Moffett, Michael Nathanson's colleague.
Sure.
He was years out front on cable cutting. That's what this is about, is people are watching less, period.
What have we ended up with, Tom? Tons of different apps. Tons of different apps.
What's your total per month? I bet you know
just
the
ridiculous.
Penny. I've never had
not
mine
to the
up.
penny, but it's a lot now. It's a lot. And Geetha, it's going to be a lot more. So the ad-free version of Disney Plus is going to cost $14 a month in October, from $11 currently, How many people do you imagine are going to cancel their subscription based on that move?
Disney is betting that not many people are going to cancel at all. So that they already did a price increase just at the end of last year. They said that the results of that were actually very, very encouraging to them. And remember, John, I mean, this, the whole streaming narrative has really changed. Initially, when all of these companies made that pivot, it was really a volume story. Now it's a pricing story, right? It's all about ARPU growth. It's all about increasing that top line. We're seeing kind of Netflix do that. We saw Paramount Plus kind of raising their prices. Now Disney is doing it. And if you just kind of look at Disney versus Netflix, I would argue that Disney was substantially under-earning, right? When they introduced their ad-free product, it was $7 a month. Now, of course, they're making it up close to almost $14, which is on par with Netflix, with $15.50 for an ad-free version. So they were under-earning. So it's time that they kind of narrowed the gap.
Would you be happy if they sold their streaming business to Apple?
I don't know if that would even pass regulatory muster. And again, I think the streaming business makes sense. They have all of the content engines, obviously the studios. It kind of depends how they divvy up the assets. Yes, if they sold the studios and the streaming business together, that might make sense. But then again, who would want to buy the parks? It's going to be very interesting to see how exactly, if at all, a deal goes through, how those assets kind of even get divvied up.
Geetha, thank you. Geetha Raghunathan there of Bloomberg Intelligence. On the Walt Disney earnings, Tom. You're frustrated by this conversation.
I've never bought it from day one. I have the clearest memory of being in Hollywood, I'll say 3 or 4 years ago, and you drive down the street. We got the Bentley, we're going down the street, and they got up on the light post, they got the Paramount. They're selling Paramount streaming, Paramount this, Paramount that.
Yeah.
Their market share is like 2%. Or whatever it is, maybe it's 4%. But these are, Disney's like 8% market share of streaming. Netflix is killing them. This is not rational. This is not the way adults talk. But then it's Hollywood.
How do adults talk?
They talk about market share scale. What are we going to do to affect a transaction? Who's on the other side of the ESPN transaction? John Sky?
So you're saying they don't talk about, Cinderella and Mickey Mouse? Is that what you're saying?
No, what they're talking about right now is what do we do after
Disney.
Barbie? I'm sure that's all they're talking about.
It seems like there is a bigger discussion around which parts of our business are the most important and are core to everything that we do. And in the past, it was a broader suite of core businesses, and now it is the parks. We hear sole emphasis on the parks. So there is a question about what isn't core and what they're going to do to rationalize or get the kind of critical mass that is relevant.
John, I like what Zero's Hedge said yesterday about the parks. You got to give away your left kidney to go to them.
It's so expensive now. It's ridiculous. When people break down the cost of that to me, I'm like, why? Why would you do that?
We went once when I was a kid, when I was about 5, because we got free tickets.
Okay,
ESPN needs English football. That's what they need.
Well,
it's like a weekly show, Tom. You could do that.
A weekly show
Saturday
on the weekends.
mornings, Saturday mornings on
Some
TV.
talk show.
ESPN before the games. That'd be great.
The English Premier Formula One show would be great. John, they just were in my ear. The countdown clock, just 7 minutes. Go to McKee.
Is it 7 minutes? I was going to go to Mike anyway.
Go to McKee.
That's a tradition. Yeah, Mike McKee. How many minutes until the CPI report comes out?
Well, it looks like 7 minutes, John.
There we go. What are you looking for,
I
Mike?
heard that somewhere.
Crushing it.
I'm looking forward to streaming surveillance and Tom Keene and Roy Keane from...
Yes.
Wouldn't that be a great pairing?
Tom has no idea who his cousin is.
I just want to hold the mic. John, what is it about the mic that they put up like this? That's the British mic?
It's a lip mic.
Oh, yeah.
It gets rid of the background noise. Yeah, I've used those when you're in a very crowded
When you're in the stadium,
situation.
Tom.
Yeah.
All I had was the little pastry thing that you didn't tell me.
You had a pie.
Yeah.
And you waited with a knife and
They
fork.
were all taking photos of me because I looked like
the American
a
understand
terrorist
eating
over
a
there.
pie with a knife and fork.
What do we got here, Mike? We're 5 minutes, 50
well,
seconds
we've
away.
got, in theory, an indication that inflation continues to slow. That's the bet. Headline inflation pop up a little bit because of energy prices and base effects, but the core is expected to drop, and the month-over-month increases are supposed to be still small. Any difference would probably send the markets into a tizzy, especially if it were higher. There is a lot of talk these days about, have we gotten as far as we can go for right now with the Fed not doing more, and are we going to see the economy reaccelerate and inflation reaccelerate? And you see that a little bit in the inflation futures.
So today, do I ignore year over year? Do I ignore that?
I would ignore that, yes. Look at the month over month. But the other thing is, as I described CPI yesterday, this is the least consequential, most important report that we have this month, because it's important and the markets will trade on it and everybody will talk about it, but we have 2 more inflation reports before the Fed meets again, so this one won't
Did he just
change
say
their
this
mind.
is a snooze fest?
No, it's not a snooze
Well,
fest.
within
It's still
5
gonna
minutes,
have
sell it.
information
Sell it.
No,
content.
do you know why it's not? Because it's Mike's birthday, and this is how he likes to celebrate his birthday, is with
Happens in
CPI
inflation
reports.
data.
And it's to make sure that, especially if people are buying him gifts, he knows just how much more we're all paying.
That's true.
Do you like Stuart Wiseman?
Yeah.
Just checking.
What about Michael Kors?
There's some stuff that's okay. Yeah,
Coach, okay, all right. We'll figure something out for you.
Right.
Mike, happy birthday. Thank you. You got Mike a gift, Tom?
I don't know. I don't
That's
know.
a no.
He
All right,
gets,
great. Yeah.
he gets a fruit basket from the Fed. No, the Fed sends him a fruit
Oh, right.
basket.
Oh, right, really?
Yeah, they do.
Maybe just the
nice.
first question.
Okay.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The inflation report in America just seconds away. The scores going into it on the S&P 500. Equity futures rallying all morning, up 0.5%. In the bond market, treasuries rallying all morning. Yields are lower by about 4%, 4 basis points going into this one, to about 4% on a 10-year at 394.17. With the inflation report around the table with us here in New York, here's Mike McKee. Morning, Mike.
Good morning, John. Well, the numbers are in, and the numbers kind of match what was expected. You guys out there forecasting this hit it on the head. CPI 0.2 gain for the month, and CPI core 0.2 gain for the month, with pushes up the headline year-over-year figure to 3.2% and drops the core year-over-year to 4.7% from 4.8%. So, as the bond traders would say, this one was on the screws, came in right as forecast. Initial jobless claims, let's not forget that. This one jumps. We're up to 248,000. The prior week was 227 on an unrevised basis. We'll get the revision in just a second. Those are dropping slowly. But the continuing claims number, 1,684,000, that's down from 1,692. So a little mixed news on the jobless front, and it could be some strike activity in the initial jobless claims, but we don't know for sure. We'll have to look into that. But claims are not the good news. For you at home, you're still getting ahead of inflation. Real average hourly earnings come in up 1.1%. That's a little bit slower than the 1.3% in June, but it still means you're making more than inflation's going up.
The initial reaction, Mike McKee, thank you very much. The equity market up by 0.8% on the S&P 500. In the bond market, that rally extend to the front end. Yields lower there on a 2-year by 7 basis points to 4.73. In the FX market, further extra dollar weakness. The euro breaking out now by 0.75% against the US dollar on the session. That currency pair positive by almost 0.8% now. Tom, 110.60 on the euro. So in line for CPI, month over month. Further signs of disinflationary forces taking hold.
Yeah.
Equity market up, bonds rallying, dollar weaker.
I mean, I thought Mike was dead on there, on the screws, as he says. And the answer is, I look at inflation-adjusted weekly earnings, and it is a quiescent number off of a revised 0.7% inflation-adjusted a weekly increase down to 0.2%, positive 0.2. So that's a kind of disinflationary tone, and that makes everybody, including the stock market, feel good. Maybe the Teamsters will not make 170,000; they'll make 167,000.
Mike McKee, have you got that super core print? Have you got a read on that just yet?
I don't have the super core just yet, but I can tell you that rent of shelter and rent of primary residence and OER, all those numbers come in at 0.4. So that is about the same in line as it was the prior month. So no great drop in overall numbers. But the owner's equivalent rent comes in up 0.1 at 0.5. So that's not going to be seen.
I'm looking over at Mike here with 7 pages of printout here. It's totally impossible. First of all, I can't see it. Your eyes are better than mine. But my answer is we got a 1.1% move in NASDAQ 100. Obviously, the market likes what it sees. What do you see in that blur of data that tells you they like what they see?
Well, what you're seeing here is basically, in most categories, just a small increase in inflation. We're seeing a definite slowing down overall. Food prices up 0.2, food at home up 0.3, which is a bigger gain than the flat number last month, but it is still not huge. Energy prices contained, even though we saw gasoline going up at the end of the month, it was only up by 0.2. And then you look at used cars down 1.3%, new cars down 0.1%. So we're seeing, and apparel flat, we're seeing basically inflation that is relatively tame. I mean, these are the kind of numbers we used to get prior to the pandemic, before we had the big inflation run-up. So this isn't too bad.
Kind of like what we saw in the payrolls report, Mike. It's like a pre-pandemic report in some ways.
It is, and the weird thing is we don't know if this is a pre-pandemic report or if this is just the way things are these days.
Well, that's the question.
That's the hard part to know.
Does this change after the summer? Have we got the ingredients here for a re-acceleration in inflation?
Well, that's the argument.
The
macroscope column Simon White wrote this morning on Bloomberg suggests that this is the best, and now we're going to see inflation go back up again, and the market's going to be caught wrong-footed. I know Neil Dutta is going to come on and tell us that we're all crazy to think that, but
Jim
there
Bianco,
is an
Bianco Research
argument.
has made that point. Yeah,
there is an argument out there on that.
Let's turn back to the equity markets. So equity futures initial spike. It fades. We're positive by 0.6%, which is basically where we were going into the number. Looking at the bond market, yields were lower on a 10-year going into that by about 4 basis points. Now lower by a couple of basis points to 3.98. We're down 6 at the front end on a 2-year. Let's call that 4.75. Dollar still weaker against the euro. That fades a little bit as well. The euro, that move on that currency pair, 0.6%. Coming up in the next hour on Bloomberg TV, Jean Bavin of BlackRock. He knows something about central banking. Robert Tipp of PGIM Fixed Income knows a little something about the bond market, and Sarah Malika-Nuveen knows a whole lot about the equity market, Tom. All of that still to come.
Interesting to see Brent crude 87.37 off this. I'm going to call it a churn for oil, but nevertheless pushing against the disinflationary tendencies outside of core CPI is what we're seeing in a gallon of gas. Neil Dutta is an optimist. He's head of U.S. economic research at Renaissance Macro Research. He's absolutely nailed the better than good American economy. Neil, I got to go to GDP first, and then Lisa and I want to dive into this inflation report. And the basic idea, Neil, is Atlanta GDP sees a sprightly initial start to the quarter. Are you at a 3% run rate on a real GDP, or are you at a lesser run rate?
Well, I mean, remember, it's still very early in the quarter, and the Atlanta Fed tends to get, that estimate tends to get better over time as more data comes in. But even if you assume, a typical kind of, error term, and like, let's say it's all going down, you'd still be talking about above trend growth. So it'd be really hard for me to see, GDP coming in something below, 2.5%. when the quarter's all said and done. There's just a lot of momentum behind the economy, right? So when you hold things like the level of consumer spending flat to where it was in June, you're still talking about a build-in for the third quarter from consumption of over 1% at an annual rate. So I think that's primarily what's driving the GDP now estimate. But yeah, look, I mean, the economy is growing above trend. Your own Bloomberg consensus sees GDP, I think, barely 0.5% in the third quarter, negative in the fourth quarter. I think that is highly unlikely, and that revisions will, be skewed to the upside.
So right now what we're seeing is a broad sigh of relief in markets with some cheering in the bonds, where you're seeing basically people writing off the Fed, raising rates again, and saying you are seeing the soft landing. You are seeing the disinflation, you can call it immaculate or whatever else, that a lot of people were waiting for. What in this data can you point to say they're wrong?
Well, it's not much. You could make the argument, I think, that the downward movement in used cars will probably only build over the rest of the summer. We do know that wholesale auction prices continue to come down, and thus far we've only seen a very modest decline in used car prices, so there may be some more pass-through there. So I do think that there's probably a little bit more disinflation in the pipeline. But again, I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend. I don't think the Fed has done enough. And I think the Fed is kind of enamored with this soft landing view. They're almost wish casting this outlook. And I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year. We do know that home prices are rising. While the relationship between home prices and rents is very tenuous in the short run, I mean, ultimately, the asset market effect is what drives rents. I mean, landlords don't charge, they want to extract more from tenants when the underlying value of the asset that they're putting on the market is going up in price. And commodity prices, look, I mean, oil is at year-to-date highs, more or less, with everyone concerned about China and Europe. I suspect these economies probably won't get much worse than they are now. I mean, that would be my baseline expectation. And there's probably, in other words, there's more room for oil to go up. And that's going to have very mechanical impacts on not just headline inflation, but parts of core inflation as well.
I've been looking at the pricing in markets of Fed policy and where people are settling out. And they're now pricing in cuts at the first couple of months of next year. And I'm wondering, from your vantage point, Neil, how disruptive it would be if suddenly that market complacency is challenged by the idea of stickier inflation, reaccelerating inflation that wouldn't even cause another Fed rate hike, but just wouldn't necessarily lead to those cuts.
Yeah, I mean, it depends, right? Because if it's a stronger economy and stronger growth expectations that's making the market price out those cuts, I mean, that could be in an environment where equity markets could potentially work, right? So you see higher interest rates and that hurts, but you'd expect earnings and expected earnings expectations to go up, so that could be okay. But I do think, to me, it comes down to something very, very basic, right? The Fed began hiking in March of last year. And since then, what do they have to show for it, really? Powell talked about pain being necessary or likely. We've seen the unemployment rate actually tick down since then. GDP is growing above trend. Broader financial market conditions are as easy now as they were then, maybe if not easier. All deference to the Fed's new financial conditions framework. That number, when it was published, showed financial markets being a headwinds. Now that has basically gone to zero. So what have they actually done? So I think it comes down to something very basic. Either you think the labor markets are a conduit for inflation, or you don't. And I think what we're seeing now is basically tight labor markets, a lift to real wages and I think ultimately people will go out and spend more money, booming household demand, and I think that'll keep prices in the aggregate stickier for longer.
In the aggregate, Neil Dutta, thank you so much with Renaissance Macro here this morning. I think the heart of the matter is in the aggregate, and that maybe, Lisa, there's two Americas. There's one that is prospering. They're going to Disney World. They're giving their left kidney to go to Disney World and all that, and there's another that's flat on their back. And Neil has been brilliant about parsing that into the aggregate. And
there's also where you put the priority in terms of what you're going to spring for. What are you going to spend on? And you see that too, people kind of being a lot more discretionary about where they splurge.
You're turning the bond market right now. Standard & Poor's 500 lifts a little bit, up 0.3%. Right now, Michael McKee with us here doing the math. He doesn't have like an HP 12C, on his calculator. He's got an old Cray supercomputer under the desk to figure out what's the thing you sum together here. Service sector, Jerome Powell's
core services ex housing.
Core services
is the Powell indicator, and it's generally
is summer camp services.
There are different definitions of supercore, but
is
this
inflation in summer camps services?
Yes.
I'd have to look at summer. Well, let's see if it's in here. I can tell you that as far as Disney World goes, that admissions to recreational places up 1.3%. That's one of the higher things. So you were right, Lacey. You called that in terms of park admissions.
What do you see seriously in the service?
The Supercore number comes in at basically 0.19. So you're looking at just under 0.2% for the month, which is up from flat the prior month. And on a year-over-year basis, we're looking at 4.2%. So that goes up a tick as well. I don't think that's going to worry the Fed all that much, but it is not going necessarily in the right direction. So we'll keep an eye on that going forward. Airline fares, though, you bought your ticket to Jackson Hole, right?
Yeah.
Because they're down 8.1%.
Yeah, where?
So
precisely, there's the PhD question.
I'm sorry, but and besides, it's down from what, right? Yeah. People are saying, "What are you kidding?" Because the year-over-year cost is still so high.
Yeah, everybody looks at what they're paying at the checkout stand, and it's they don't notice.
Yeah, they don't notice the decline.
Bacon was down 0.7. Yeah. Did I notice that?
Exactly.
Michael McKee, thank you so much as always. Leading coverage worldwide. Michael McKee. This is Bloomberg. Good morning.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We have a post-CPI clock, which is now 16 minutes past the CPI print, and nothing has changed. This is Bloomberg Surveillance. Tom Keene and Lisa Abramowitz, John Farrow off preparing for the 9 hour. And I do feel like this was not particularly exciting for markets. That's my sense.
I think if you dive into the data, there's going to be some excitement there. There always is in hundreds of data points, almost like a David Rosenberg analysis. I really don't care if it's up, down, vector, whatever it is. To me, and you've mentioned this a couple times this week, Lisa, it's the x-axis. It's the how longedness of whatever the policy outcome is. I think people have to learn that there's not going to be drama, and they're going to stretch it out to this Jackson Hole, maybe the next Jackson Hole, or Jackson Hole 2025.
For now, it definitely is cheering a bit of good news in the markets. You could see bond yields down, bond price up. You could see stocks up marginally. Take a look at the two-year yield, 4.77%. That's after climbing as high as 4.8%. The 10-year now below 4%, but not a lot of drama, just kind of meandering around the same place. You see the S&P up about 0.4%. We have been talking about a couple of stocks, a couple of stories in this era of more inflation, but still strong consumer spending. We keep coming back to the luxury or almost luxury or whatever you want to call it, the retail sector and consolidation, and whether size matters so much more now that it is important to pay a premium. Tapestry shares down 6.3% after saying that they are going to buy Capri Holdings, the owner of Michael Kors as well as Versace and others, for $8.5 billion. You could see Capri shares up by 57%. I think this is an interesting deal because it shows the need to consolidate, the need for size.
Scale, 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 the great zombie roll-up. These are not zombies. These are legitimate firms. They're not trash. But the stock performance are really of both Tapestry, I'm going to call it mediocre as a general statement, and Capri is actually worse than that. The answer is it is that mid-luxury roll-up. Bloomberg Intelligence will have some terrific work on this in the next 12 hours or so. What I would really focus on, Lisa, is I'd focus on Madison Avenue, and it gives you some scale through real estate negotiation worldwide.
That's a great point. I also just want to quickly mention, because we are about 40 minutes away from the opening bell, very curious to see whether this gain in Disney is going to hold, Tom, given the concern about the longer-term trajectory of growth. And I'm watching Novo Nordisk. At what point do people start to say, okay, if they can't make it quickly enough, that's going to be a boom?
We got a great viewer that says he's lost 51 pounds or whatever with his stuff. He was
but grown an extra arm?
Yeah, whatever. But he's, I guess it works, but you just can't. There's got to be a free lunch factor in here. Have you discovered what it is? You've done better work on this than I have.
It's still breakfast time for some people, so I think
it's a shot.
Yeah, well, that's Ozempic. I mean, basically, there are some, nausea and other types of physical issues that kind of come along as potential side effects. Anyway, we'll investigate. We'll do a deep dive into the potential ramifications.
Let's pick someone that could probably use this stuff. I'm going to mention Euro Yen 158.70. I'm watching it like a hawk. A 160, 160. Strong Euro weak yen would be something to see overnight in Japan. We get clarity now on an August Thursday with David Kelly, Chief Global Strategist, JP Morgan Asset Management. He has been definitive over the decades of the holistic picture. David, I do want to get to your stunning call on jobs, but let's leave that aside right now. Do we have disinflation in America?
Yes, we've sort of got gathering disinflation in America. We've got the numbers this morning were close to what we thought, but it's nice to see the sort of the core services part of inflation coming down. But what I think I'm most interested in is actually, it's not actually the numbers, it's forecasting the numbers. Because when you're trying to forecast these numbers, you realize, okay, new car prices have basically been flat or down since the start of the year. And we're still seeing these huge increases in auto insurance and auto repair costs, but that's got to break. And same thing with shelter costs. Shelter is about 90% of the increase in CPI at this stage, but we know the rents have stopped rising. We know that there's a rising vacancy rate for apartments. So what we can see is the promise of future disinflation in these numbers, and really trying to forecast these numbers. And that's why I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
In your summed statement, and you and I have talked about this over many years, including with Bob Goodman years ago, there's an underestimation of the x-axis. Are we underplaying in our what's going to happen next quarter, what's going to happen in Jackson Hole, what's going to happen to the meeting? Do we need to extend out our study a year out, or dare I say 2 years out, to get to a successful disinflation?
Well, for investing, you always should, because equity investing. Most of your viewers are interested in the stock market. It shouldn't be about the next year anyway. But yes, I think particularly this time around, I think that's the case, because what we know with inflation is it's very symmetric. It actually looks like the Eiffel Tower. It goes up and comes down in exactly that pattern. We saw it in the 1970s. We're seeing it again now, 40 years later. But it takes a little while to come down. And it's because of lags in things like transportation services, and particularly owner's equivalent rent. And so as we track this thing out, it's going to hit 2 on CPI and on core CPI by late next year. And that's the track it's on. So I think you have to wait for that to play out. And then you realize that, okay, where does that leave us? That leaves us in a low inflation, slow growth economy. I think the Federal Reserve will be cutting interest rates obviously faster if we end up in a recession. But I think you have to sort of look out beyond the volatility of inflation that we've seen in the last 2 years to realize that we're headed for a place of slow growth, which looks quite like a decade ago. I think that's really sort of a return to where we were 10 years ago.
If that's the case, why wouldn't you take a look at where markets are positioned and just load the boat with 30-year treasuries and say, everyone's wrong. They think that inflation could get unmoored if the Fed is less aggressive. I don't.
I wouldn't back up the truck, because I think there are better opportunities in markets than 30-year treasuries. I do think that the bond market overall is better priced than it's been for many, many years. And I think there is a one-time capital gain there as rates come down, as people realize the Federal Reserve is going to have to cut rates. Because sooner or later, this economy will stumble, and a 4% 10-year treasury yield will turn to a 3% treasury yield or a 2% treasury yield, and people will make a capital gain. But I think there are better long-term capital gains to be made still in the equity market. But I wouldn't be underweight fixed income right now. And within fixed income, I would be definitely long duration and short credit. I don't think you're getting paid for taking credit risks. You are getting paid for taking duration risks.
Dr. Kelly, I've got to do this. It's too important. Jason Furman of Harvard just comes out with the mathematics on the annualized view. 12-month annualized, 4.7% core. 6 months, the view is 4.1%, a lesser disinflation. 3 months, which is what I look at, 3.1%. David Kelly, the 1 month annualized core CPI is 1.9%. Can you go short-termism and look at those 1 and 3 month statistics? Are they a valid tool to gauge disinflation?
I don't think so, looking at the CPI index, because what's really going on is you've got these weird categories in owner's equivalent rent, actual rents, and transportation services. And I think you just have to track what that's doing. I agree with the general proposition that core services inflation and inflation in general is fading here. I do not think it's getting pushed up by wages. I do think it's getting pulled down by competition and by increased inventories. Here, I do not think it's getting pushed up by wages. I do think it's getting pulled down by competition and by increased inventories. So I agree with the result, but I think the short-term view is really being affected by the way the government measures these things.
David, thank you so much. David Kelly with JP Morgan this morning. Lisa, I can't say enough about this is the debate into the weekend and the debate into Jackson Hole. You look at a 1 year core CPI of 4.7%, or as Professor Furman says, do you go short-term and look at 90 days and say this is the inflation trend and it's a disinflation, to a core CPI right now of 3.1%? That's a huge debate.
And if you just take a look at the basic numbers, you could see that CPI just posted the smallest back-to-back gain in 2 years.
Nice,
so it's definitely ending up with this disinflationary kind of feel. If you look beneath the headline, some of the most incredible increases in costs, nursing home and adult care, costs surging by the most on record. You could see housing accounting for 90% of a lot of the CPI
I think
gains.
that's important. That's true.
You have a lot of, rather than the other, but I do think, you can look at medical costs that have been increasing dramatically. You can look at other areas.
Yeah, seasonally medical always pops in the fall.
But the costs that people are feeling are still climbing. It's just that you can say at a much slower pace, or even if you take a look at some disinflation, and as Neil Duddy even conceded, there is more disinflation in the pie coming from you, daughter.
I mean, I look at David Rosenberg or Edward S. Hyman, and they're going to just say to me the disinflationary trend last 90 days is in place. That's what they're going to say.
Yeah, but year over year.
Jerome Powell can't say that. He's
and
got to
year
stick
over
with
year.
year over year.
I mean, we're coming from also the highest inflation ever.
Yeah.
Or at least 30 years or something like that.
Well, here we are. Stay with us. The equity markets lift. This is Bloomberg Surveillance.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well,
first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
No drama in that CPI report. Get back to the beach. Live from New York City this morning. Good morning, good morning. Equities higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the smallest back-to-back inflation increase in 2 years, leaving the door wide open for the Fed to pause as the president continues his Bidenomics tour. We begin with a big issue, inflation in America.
It's all about inflation and what those data show.
CPI today
will be very important.
Important as the Fed convenes in September.
That's what the Fed has said, that's what they're looking at.
They're trying to figure out what their next move is going to be.
We are in a disinflationary trend.
A disinflationary trend.
We're probably at the Fed and the end of the Fed tightening cycle.
Additional Fed rate hikes are definitely still on the table.
I see more inflation as we head into the back half of the year. The second half of the year, inflation ticks higher.
I just don't see core inflation coming substantially below, say, 4.5%.
That is very much the elephant in the room. It's too soon for the Fed to make a call on that September meeting.
We have a lot of data between now and then.
You have another payrolls, you have another CPI.
Friday's PPI reports.
A lot more data to come out in the next couple of months.
Depends on the data.
Let's get to the panel. BlackRock's Jean Barvan, PGIM's Robert Tipp. Jean, first to you. Your takeaway from that data 31 minutes ago.
Well, I mean, now we've seen a streak of numbers, I think, that clearly show very serious progress on inflation for now. I think that, that cannot be ignored. But I would say, taking a step back, and this is what we're going to need to deal with over the next few months, is that we've been of the view this is going to be a roller coaster. I think we're seeing now that the downside of that roller coaster, I think that's going to lead to some way up as well. So maybe amplification of the roller coaster is one of the a story that comes out of this for the next few months. But it is an unambiguously great progress over the last 3 months we've seen.
Robert Tipp, is this the best inflation report of the year? And will it be the best inflation report at the end of the year? Do things get better from here or get worse?
It's a great inflation report. And I would think there could be, more of these and maybe a lot more of these ahead. I mean, I share some of the skepticism. I mean, airfares, for example, in the last 4 months are down about 20%. And I think there are areas out there that have upside risk, like energy and housing and so on. But it's not just in the U.S. that you're seeing these numbers. And even in the U.S., it's not limited to inflation. I mean, the non-farm payrolls have had a very steady decelerating trend. And that combined with these numbers, and the Fed is numbers driven, even if maybe they're not a complete, match to reality, this is going to really put them on hold and have them asking themselves, gee, maybe we could be cutting rates in 6 to 12 months. And I think one of the things that adds to credibility on these numbers is that we're seeing this globally. Some of the places that were leading on the way up with the rate hikes, like Brazil, Chile, are seeing inflation numbers come down. So it's a phenomenon out there. We'll have to see how much durability it has, but it's good news.
From your perspective, Jean, how much of the improvement we've seen so far is down to the tightening from the Federal Reserve over the last 12 months? How do you identify that?
I think we've never gone through these to this period, this shock. This is totally unprecedented, and very difficult to put really strong confidence on how much is due to the Fed. But our view is we're basically living the consequences of two massive shocks, unprecedented. The first one is this pandemic sectoral reallocation, something we've never seen before, both in terms of its occurrence and magnitude. And I think the conclusion we're reaching here is that this has been unwinding, maybe more quickly now than would have been thought a few months ago. So at first it was slow to play out, but this goods kind of deflation is accelerating. You're seeing the normalization happening, less pressure on the labor market coming from that shock. And so I don't think that has much to do with the Fed. I think this is normalization from the pandemic that took longer to play out and now is accelerating. Now, the Fed's going to start to have an impact, and I think this is coming next. And that's at the same time as we're seeing another big shock, unprecedented, which is this aging into retirement, something that the U.S. has never, ever experienced before. It turns out now we're reviewing and learning that it hasn't been really playing up or biting yet. But this is now we're getting to the point where it's going to bite. And I think in terms of the implications for payroll, for instance, they are decelerating, but nowhere nearly as much as what would be needed to bring them back in line with what the demographics are implying. So we should be payroll numbers are about a third of of what they're running right now. So the deceleration is happening, but there's a lot more that needs to happen for it to bring the labor market in equilibrium and avoid the leg up in inflation that's going to come from these demographic shocks. If we don't see the deceleration.
We're going to build on that in just a moment. Let's turn to the equity market, about 25 minutes away from the opening bell. Futures here positive by 0.75%. The equity market, like the report, the bond market too, yields lower at the front end by 4 or 5 basis points on a 2-year, 4.76 on a 10-year, in at around 4% over the last couple of weeks. We stay there. We're down about 4 basis points on a session, 397. With more on the data, here's Mike McKee. Morning, Mike.
Morning, John. Well, it's a very happy CPI day for Wall Street economists who nailed their forecasts for CPI. Comes in exactly as expected on a month-over-month basis, up 0.2, core up 0.2, and that pushes the headline up by 0.2 to 3.2% and pushes core on a year-over-year basis down to 4.7%. Jay Powell's favorite indicator, core services, ex-housing, is a little bit higher, 0.2 gain after a flat June number, and 4.1% after 4% in June for the year-over-year. A couple of other numbers out today, and I think my chart is not accurate. It is through June. It doesn't show the latest through July, but basically we saw jobless claims go up on the month to 248,000. That reflects the yellow trucking bankruptcy for the most part. And the real earnings number is good news for people, still up 1.1%, a tick lower than last month, but it does show that incomes are rising faster than inflation. And finally, we have to ask what this means for the Fed. You've been talking about that, and at this point, nothing. I talked about this being the least consequential, most important number, and we got the number, and this is the odds of a November rate increase, and they have not moved at all. They're basically at about 12% for the month of September and 20% for the month of November. So basically, the market priced out and is keeping it that way, the idea of additional Fed rate increases, but we do have 2 more inflation reports before the Fed has to make a decision.
Mike McKee, thank you very much. Mike McKee on the latest. There is just this extreme comfort right now, extreme comfort with this idea that incoming information between now and the next Fed meeting will not challenge this soft landing narrative, and this Federal Reserve will skip September. Let's see if the data challenges that. The unknown is after September, into the end of the year, and Jean Bavin was talking about that. Robert Tim, Neil Dutta of Renmac was on the program with us about an hour ago, and he was really pushing back. He said quite firmly, either you believe that labor markets are a conduit for inflation, or you don't. And the question, Robert, we've got to ask is whether unemployment at 3.5% is consistent with bringing inflation back down to 2. Is it?
Right. Well, I think all these things are right on point. And I think, first of all, you asked about how much of this has to do with the Fed. Central banks around the world hike a lot, and that has taken the edge off of this growth. And if we're getting a soft landing, and by the way, Jerome Powell was there for the last soft landing, it is going to be, to some extent, owing to the fact that they have hiked and taken the edge off of this. In terms of unemployment rates and the demographics, that is an entirely flexible construct in English-speaking DM countries. I mean, in Japan and China, that's a different story. But in the last year or two, the UK, Canada, Australia, New Zealand, and the United States have had huge increases in foreign-born workers in the workforce. We're talking 5 million people in the U.S. entering the labor force, foreign-born, in the last 2 years, which is as much as the last 10. So, you know, in some places that would hold, but I think that's why the central bankers, they don't hold to a NAIRU, because they don't know what it is. And when you look at how few households are surveyed for the payroll reports, how few businesses are surveyed, you really have to look at the wage numbers. You have to look broadly to see if you're overheating or not. And although labor is picking up strength here, no doubt, you're not really in a worrisome situation. If you were, I don't know that you would be seeing such a rapid deceleration in the inflation numbers.
Well, September and beyond, they've got a decision to make, Sean. They've got to ask themselves, what's the biggest risk for me now? Is the biggest risk holding rates at these levels too long or backing away too soon? What's your assessment of those risks, Sean?
Well, my assessment is that, you know, with the data streak we've seen here, and I guess our view that this is like a combination of two shocks that are unprecedented playing over different time horizon, and one that we've made a lot more progress in handling and normalizing from. I think that now gives them room to hold tight for now, hold tight in the both sense of the term, right? So I think they can sit tight for now for some time. But that's in a tight kind of position, and I guess that increased the odds of now being close to that point. On the other hand, I don't believe that they will be in a position to ease anytime as soon as the market is expecting, which is early next year. The odds of that happening, I think, in this environment are extremely low. I agree that the labor market NAIRU concept is a very vague one. They won't be guiding by that. But it is the fact that, you know, by all accounts, you're going to look at a market that looks unusually, you know, tight. And to us, the main thing to track will be employment growth relative to this demographic shock, unprecedented. And we think we're at the point where this is going to start to be binding. So I think they'll put some weight on this, and that's going to lead them to hold tight for now. But I don't think they'll be able to ease as quickly as the market is expecting.
Jean Bavin, Robert Tipp, sticking with us going into the opening bell, about 20 minutes away. Equity futures here up 0.6%. With your movers, here's Abby.
John, let's start out with some of the winners that are helping the U.S. futures this morning. Starting out with Disney, shares are reversing yesterday's post-market loss as investors look past the second quarter subscriber miss and light revenue to the 4% adjusted earnings beat on park strength. Plus, the company is sticking with their plan to cut costs, specifically around media content, $27 billion for this year versus the norm of $30 billion. Investors seem to like that. Apple up about 0.7%. A possible second update into today, down about 8%, the worst stretch of the year on growth concerns from their last quarter. And some are actually talking about Apple buying some of those Disney assets that Bob Iger was talking about selling. And then speaking of buying, Tapestry is down 8.5%. They are, of course, buying the owner of Michael Kors Capri Holdings in an $8.5 billion deal. That represents a 65% premium. And yeah.
Abby, thank you. On the latest, we'll pick up on that story around the opening bell. Coming up, President Biden heading west.
Where is it written that America can't lead the world again in manufacturing? Because we're going to do just that. The leading manufacturer in the world.
U.S. inflation in focus as the president continues his Bidenomics PR tour. That conversation up next.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while
This is a 3 as the economic picture does.
The OK is getting ready to make this decision.
Where is it written that America can't lead the world again in manufacturing? Because we're going to do just that. The leading manufacturer in the world. The plan is to invest in America. We're transforming our country, including by rebuilding America's infrastructure. I'm not here to declare victory on the economy. We have a lot more work to do. We have a plan, and it's turning things around. Bidenomics is just another way of saying restore the American dream.
The president speaking in New Mexico, continuing his Bidenomics PR tour with a final speech coming this afternoon in Utah. The remarks coming amid the smallest back-to-back inflation gains in 2 years. Katie Lyons has more. Hey, Katie.
Hey, John, Biden in the third state he will have visited this week today is going to try to make that message again, tie what we are seeing in the economy, manufacturing resilience, labor market resilience, and inflation going down directly with his policies. Things like the Inflation Reduction Act, the CHIPS Act, which had its 1-year anniversary yesterday, and infrastructure spending as well. And in theory, the data this morning does support that message from the president. Inflation is indeed slowing in pace under his watch. A few political difficulties, though, for President Biden is that American people don't necessarily seem to think that he is doing an excellent job with the economy. We continually get data out that shows large dissatisfaction still with the president. And a new Reuters Ipsos poll released this week, 49% of those surveyed said inflation or increasing costs is the most important issue. 64% said the economy is worse off compared to 2020. And a minority of people polled are actually even familiar with the same legislation that the president is on the road trying to tout. So that is why he is doing that, why he is going out there trying to get this message out. But clearly, he has difficulty getting it to resonate. And we have to keep in mind that even though data does show that price growth is slowing, prices for many goods that American people have to pay for are still higher than they were in 2020 or pre-COVID. And especially the most visible signal of inflation, gas prices, prices at the pump are about 30 cents higher here at the beginning of August than they were at the beginning of July. And that speaks to that 3.2% core headline figure, not core, that shows those volatile prices that actually ticked up, John.
We're making some progress elsewhere, Kelly Lyons. Other places, not so much. Jean Bavin, let's talk about one. The budget deficit. Have you ever seen a budget deficit this big and unemployment this low?
Yeah, probably not. In terms of the exact combination, we've seen periods where we've seen, pretty buoyant economy, low tightened labor market, driven by fiscal policy and expansionary fiscal policy. But at this juncture, with the debt level that we are at, this is unprecedented. This is part of the, I guess, the medium-term story. I think this feeds into how we should be thinking about the yields outlook, not about the Fed policy rates, but beyond that, 10 years and so on. I think there's going to be more to play out over the next few years in that front. I think this is also part of what if we believe that the economy is so strong and there's more fiscal coming or continues to play out, that feeds into how we reconcile that with this inflation picture that is so benign.
So, Jean, put it together. Is the 10-year a sell or a buy?
Well, we're underweight 10 years plus space in U.S. Treasuries. We believe that there is room for the term premium to reappear more. We've seen some glimpse of that over the last few days. But I would say the most important thing to look at this year is just the sheer volatility that you see in this space. The 10-year yield has been going up and down on a daily basis, we haven't seen really. You have to go back to the 90s and 80s to see that kind of ongoing volatility. And that speaks to me to the fact that despite all the talk about soft landing, the bond market is not embracing it and switches on a dime. And I think to me that raises the question, maybe we're wrongly applying a business cycle frame, soft landing versus hard landing, to something that is a lot more structural.
Robert Tipp, would you take the other side of that?
I mean, I think this is a great point in bonds. I think to some extent it is a roller coaster on the data front, but this configuration of a 5% Fed funds rate and a 4% 10-year Treasury, I think it's going to be pretty durable. I agree there will be a very, very slow steepening of the yield curve. But, to that point of the large budget deficit, it is a loose fiscal environment. That's another contributor, another reason for these central banks to be a little bit more cautious about dropping rates. So the big picture, the trades here, I think, are that while everybody's worried about, get hard landing or getting over that, or is inflation going to come back, volatility is going to come down. These central banks are going to be waiting. You may get a little bit of steepening in the yield curve. That's typically great for financial assets. So I think that's going to be, the fuel for the ongoing bull market in bonds. It started a couple quarters ago. It's just based on being at high yields and earning that income, getting a little bit of spread compression. I think that's going to do it.
Robert, we've had a signal from the committee, from Chairman Powell, and from John Williams, the New York Fed president, in the New York Times earlier this week, that they'd be somewhat uncomfortable holding nominal rates steady as CPI decelerates because real rates would increase. Robert, with that in mind, they're not going to adjust every single month based on where CPI comes in. But from your perspective, what kind of real rate, positive real rate, are they comfortable with holding?
Right. Well, I think it's pretty clear that they feel they are restrictive right now. And they have been very clear. You have to listen to everybody on the committee and see how the data comes in. And they will break in the direction of the team that is getting it right. And I think that's a very healthy process. What that points towards, as you're saying, John Williams, the chairman, if they're getting a soft landing and inflation is really looking convincingly like it is down around target, a year is a long time. 6 months from now, if numbers are coming like this between now, the end of the year, they're going into next year, they could start cutting rates in order to get real rates down towards, they're not going to know what the right real rate is, but they're going to move the nominal rates to try to keep these conditions of strong growth. Because once inflation is in check, then the other objective of the Fed comes right back into play. Are you at maximum employment? And you can never know if you're at maximum employment. They have to start probing again to make sure that they don't let growth slow down at that point.
Jean Bavin, final word, please.
I think there's a real debate that is happening right now about what they think is the neutral rate, both long-term and short-term. They're revising their models as we speak. They've published this week. I think there's something coming out again today. It's a live debate. I think there's a camp that thinks that monetary policy is not as tight as you would think because their natural rate estimate is going up. I don't know how much traction it's going to get. I think to me, the key thing to watch over the next, many months, 6 months, is what the labor market does in this demographic shock. And I think, again, this is a big deal, hasn't played out yet. And in the picture in 6 months could look quite different once we learn more about how this demographic is impacting the labor market. But it is interesting that Chairman Powell and John Williams and others are now explicitly articulating the scenario under which they might be cutting. I just think, to me, this is now a risk scenario as opposed to central, but it's the weight on it is probably going up from what they're saying.
Interesting. Jean Bavin, thank you. Alongside Robert Tipp, to the both of you gents. Appreciate it. Going into the opening bout, 7 minutes away. Coming up, the morning calls, and later we'll catch up with Nuveen Sarah Malik on this equity market that keeps on rallying, up 0.6%.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell, equity futures positive here. Let's get you some morning calls. First up, Morgan Stanley upgrading Southern Company to equal weight, highlighting the company's solid balance sheet and diminishing regulatory headwinds. Truist downgrading Penn Entertainment to hold $30 price target, seeing sizable execution risk after its deal with Disney's ESPN. And finally, Stifel raising its price target on Wynn Resorts to $150, expecting demand out of China to remain resilient throughout the rest of the year. Their stock is up by 1.6%. Coming up, a subdued inflation print, leaving the door wide open for a September pause over at the Fed. That conversation up next with Nuveen's Sarah Malik.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Two-day losing streak on the S&P 500. 20 seconds going into the opening bell. Equity futures bouncing back by 0.5%. This more favourable view of this market endorsed by disinflationary trends continuing in the latest CPI print. The smallest back-to-back gains that we've seen in about 2 years. Equities up. There's your opening bell. Switch on the board and get to the bond market. Treasuries running as well. Down by about a basis point or so on a 10-year at about 4%. What is it about that level at the moment? The 10-year, 4%. Pretty much every single time at the close over the last 2 weeks, that's exactly where we've been. That's where we are right now. In the FX market, the euro showing some strength, the dollar a little weakness, 110.16 on that currency pair, and crude down by 1%, $83, and let's call it 60 cents. About 20 seconds into the session, your equity market looks like this on the S&P, advancing by 0.5%, on the Nasdaq up by 0.6. One stock to watch at the open, it's Disney, the company, cutting costs and raising prices on most of their streaming offerings. The CEO, Bob Iger, saying important changes are creating a more cost-effective and streamlined approach to our operations. Ed Ludlow has more. Morning, Ed.
Good morning, Jonathan. There is so much news to discuss when it comes to Disney's report, but I think we agree that at the heart of it is cost-cutting. You look at EPS in the quarter gone, $1.03, beating expectations. A lot of that demonstration of the work that Iger has done to rein in costs. It's interesting, you look at the shares, we're up 3.8%. I know that it's backward-looking, but in after-hours trade, we were markedly lower for much of the immediate reaction. Then something on the call changed it, and it really was the financial guidance going forward. So starting with the streaming losses, they were $512 million in the quarter gone. Remember that a year ago, the streaming loss was $1 billion, and executives had guided us that for this quarter, it would be around $750 million. The commentary from Disney was that those streaming losses will continue to narrow and in an accelerated way going into mid-full year 24. And that cost discipline is key. They also talked about exceeding the $5 to $5.5 billion of cost cuts that they are targeting, going past that target. What the market really liked during the call as well was the content spend narrative. It's going to be about $27 billion, down from previously projected $30 billion. That was seen as a massive positive. The streaming business is always in focus. It did drop from a subscriber basis 7.4% in the quarter gone, missing expectations. That's almost all largely attributable to Disney Plus Hotstar, the brand in India and the Middle East. And you'll remember that they did not renew the India Premier League cricket rights. The net result was that for Disney Hotstar, subscribers dropped 25%. The CapEx guide was also lower than previously guided and what the street was expecting. All told, this is Iger saying we're committed to these cost cuts, and they're starting to show the fruits of their labors in that sense. In terms of what happens to drive growth of the subscriber base, they do see it accelerating into the fiscal fourth quarter, which is the period ending September. But really, it's all about discipline. I know that's a boring story, John, but that is what the market's cheering this morning.
But Ed, to build on that, how much of it was about discipline? How much of it was about the strikes on the West Coast in Hollywood?
Really good question. Go straight to the content spend guide, $27 billion instead of $30 billion. You cannot make or spend on content if you don't have the writers to think about the programs. That was a point of discussion. But remember, I think you and I discussed this at Sun Valley. There are two competing forces when it comes to the streaming businesses that want to be profitable. They're conscious of pulling back spending, but at the same time, you need the content slate to drive the subscriber growth. And I think that, Iger was pretty sanguine that in the end, the writers or actors strike aside, they've got the balance right in what they plan to spend versus added newer material to the existing platforms.
You need the content
and they
slate,
raise prices
but the prices
as well.
up
Sorry,
as well.
John.
Well, that's my point.
Sorry.
Do they believe
Yeah.
the tolerance is there for higher prices?
Yeah, and 4 red headlines on the Bloomberg terminal in this earnings, a lot to keep up with. So Disney Plus without ads rises 27%, $14 a month, up from $11 a month. But they seem, based on the data they have of those selecting the ad-supported tier and those that are not, super confident that there is enough content there to justify premium price point. Hulu, ad-free, jumps 20% to $18 a month. So it was a really interesting move by them. It did surprise the market a little. But I go back to what moved the needle on the stock in after hours. It was the financial guidance on spending.
Ed, thank you, mate. Great coverage, as always, on that name. That stock is up by 2.6%. Let's stick with Disney. Morgan Stanley reiterating its overweight rating after the earnings, saying this: Disney continues to benefit from its park segment, this is important, which we see driving consolidated earnings for years to come. This is a real investment positive as Disney takes meaningful but challenging steps towards improving its earnings power. We're higher there by a little more than 2%. Those gains fading just a little bit. Big acquisition this morning in the retail space. Shares of Capri are soaring after Tapestry agreed to acquire the luxury retailer in a deal worth $8.5 billion. Capri CEO saying this: we're confident this combination will deliver immediate value by joining with Tapestry. We'll have greater resources and capabilities to accelerate the expansion of our global reach. Abby has more. Hey, Abby.
Hey, John. So, yes, the multi-year trend of consolidation in luxury retail continues. As you mentioned, Tapestry is buying Capri Holdings for $8.5 billion. That equates to $57 per share, a 65% premium. And, of course, Capri owns Michael Kors, Jimmy Choo, Versace. Now, the two companies have actually been in talks for months, so this is not truly a surprise. It's more of a surprise, but the stock is clearly surprised given the fact that right now it's up 56.5%, its best day ever going back to its trading history of 2011. Both companies have been building themselves up in recent years to compete with the likes of LVMH and Kering, but the feeling is they were really no match. So now Wells Fargo is saying that because because Tapestry will have its Coach brands and the Stuart Weitzman and other brands that it has, but with Capri, it's now going to also have the Michael Kors and the Jimmy Choo brands, that they are going to be the leader, the #1 player in what they are calling accessible luxury. Plus, China is a big opportunity. Tapestry has been doing great in China. About 15% of their revenue comes from there. For Michael Kors and some of those other Capri brands, it's been closer to 6%. Capri's weakness this year has been blamed on consumer spending weakness there. Tapestry into today up 8%. Again, Capri had been down big. Now they're both basically flat. So it's interesting to see this evening of the playing field here, John. And while Capri is not quite at that price of $57 per share, it's close enough that it suggests folks think the deal will go through.
Quite a move. Abby, thank you. Capri up by 57% in early trading, about 6 or 7 minutes in. Let's turn to the pharma space. Shares of Novo Nordisk falling for a second day after touching an all-time high. The company's CEO discussing the challenges of meeting surging demand for its new obesity drug.
I'm not concerned at all. We want to make sure that patients who start on treatment can stay on treatment, so we will keep restricting a bit the starter doses in the U.S. to make sure that patients can have a good experience. We have all dose strengths available in the U.S. We are increasing manufacturing, so this is indeed a very, very positive outlook.
Simone has more. Hey, Simone.
Hey, John. Yeah, this is the same problem that Novo Nordisk has been facing ever since June 2021, when its weight loss drug Wegovy was approved by the FDA. The day after, it was the second most Googled item. Now it's still going to have to continue restricting supply of Wegovy in the United States, especially at some of its lower doses, because it simply doesn't have all the supply it needs to meet demand. I mean, we saw from earnings today, sales falling short of expectations, but enormous numbers here. 54.3 billion Danish krona versus the 55.1 billion expected, but the company did raise its outlook for sales and earnings for the year, mainly on the back of these GLP-1 drugs, both for diabetes type 2 as well as weight loss. Its big blockbusters, Wegovy and Ozempic, coming in well ahead of sales expectations. You know, the question here is, one, what kind of competition does Novo Nordisk begin to see from its competitors, especially Eli Lilly, which has Mounjaro, likely to be approved by the FDA for weight loss later this year. That one seen as maybe even a little bit better than the Wegovy option in terms of weight loss. But, you know, it's such a large market. Jeffrey says $150 billion for weight loss drugs by 2030, that it may not really matter. So then if the concern is simply keeping up with the kind of demand, how much is Novo Nordisk falling behind? And how much is this simply where we're seeing a price that's above analysts' targets? The street has looking for 12.05. We're at 12.40 at the moment.
Running so hard, so fast. Not a bad problem to have when you think about it. Simone, thank you. Let's get back to the earnings. Shares of Wynn Resorts jumping on better than estimated Q2 earnings. The upside results driven by pent-up demand out of Macau. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, currently Wynn shares higher by about 4%. That's after reporting yesterday after the bell that second quarter adjusted EPS came in at 91 cents. Analysts were looking for just 62 cents, so a big beat there. Also on second quarter operating revenue, that came in at $1.6 billion. A little bit of a beat as well. The estimate had been for $1.53 billion. And getting specific, Las Vegas did pretty well, but as you mentioned, it was Macau that really shined. Wynn Macau's hotel saw revenue of over $300 million. You compare that to a year ago, it was below $59 million. And checking in on the sell side, Jefferies wrote that it was the Macau properties that generated the greatest upside to the bank's forecast, and Stifel raised its price target on the heels of these results. And looking ahead, while it wasn't a factor in what we learned yesterday, Wynn also said that it expects to obtain a gaming license in the United Arab Emirates soon. And if that happens, John, that would be the Gulf region's first casino resort.
Katie, the stock's up by 3.8%. Katie, thanks for the update. This market rallying, nothing to challenge that soft landing narrative in the economic data we've had so far. In the last hour, CPI in line with expectations, the S&P up by 0.9%. Joining us now is Sarah Malik, CIO at Nuveen. Sarah, wonderful to have you with us on the program. It always is. This line in your research, you said you are in the lower is over camp. What does that mean, Sarah, after the data we've seen in the last hour?
Well, I think today's CPI number does support a pause for the Fed in September, but the door's open for a hike in November. We generally think that inflation is going to have a hard time hitting its 2% target that the Fed has set. So we see structurally higher inflation and interest rates for a while. We also don't see rate cuts in 2024. The market's pricing in about 3 to 4 rate cuts. Now, two things we did like about today's inflation number was the moderation in these two wild cards of used cars and also other areas of inflation that have been volatile over the recent period. But two areas that we're watching are energy going forward. We think that that's going to become a part of inflation that moves higher in the future, and also shelter prices. Real-time data is showing us that that's starting to moderate. We're hoping that continues to do so. But used car and airfares are two areas of inflation that we're glad to see those down in today's number, but they're very volatile. That's what we've seen in history.
Sarah, what are the factors behind this resilient economic growth we've had in America that you think will persist beyond, say, the summer into next year?
Two factors have been consumer and employment. Employment markets have remained strong. Last July's payroll numbers coming in at 187,000 is still a number that supports economic growth. Consumers have been spending, and that's what's been holding up the economy. As long as people are employed, they tend to continue to spend even during inflationary periods, and that's what we're seeing. As long as that continues, I think then the economy will continue to grow. We are concerned about the employment market, so they are starting to show some cracks. If that happens, I think the consumer does slow going forward, and that will get us into a mild recession. However, that is not our call for 2023, but we may see more of that in 2024.
Let's lift the lid on this equity market together and go through it sector to sector. Sarah, where do you think in this economy right now there is still pricing power for these companies?
Yeah, we're seeing pricing power. Margins for this quarter of earnings are actually holding up much better than people expected. We're seeing companies hold on to pricing while getting the benefit of lower inflation in their cost basis. That's good for margins, but earnings have been interesting in the sense that about 3/4 of companies have beat earnings during the second quarter by a rate of about 7%, but stock prices are not reacting positively to that. Stocks are actually down, having the worst reaction to positive earnings that we've seen in about a decade. So that's not great for earnings. That's showing less health for the markets. The leader being technology, which now has been very weak, trading at about its 50-day moving average. We'll see where it goes from here. But tech stocks really just have not been reporting earnings that are good enough to please investors, given the stock price run that we've seen this year in that sector.
We've had so much multiple expansion, Sarah. Where are you expecting the earnings growth to come from?
Well, most of this year has been driven by valuation expansion, and that's been the issue, is that how much further can earnings go? We're already seeing margins hold up well. Pricing power probably is at risk as inflation starts to decline and continues to decline from here. So I think that's the issue. If earnings cannot continue to grow, I think valuations for the markets are at a premium. We're going into, we're in the second half of August here, where liquidity tends to be light. I think market moves will be exacerbated. Some of the things I'm worried about are earnings, where we're not seeing a healthy earnings market in terms of stock prices. Also, the Moody's downgrade of banks, I think, and their credit ratings is an issue. Energy prices going up, that's inflationary. And even China trade data came in poorly. And then finally, you touched on it earlier, the 10-year is at 4%, and that's a headwind for equity. So with valuations where they are, there's a handful of headwinds for equity going forward. So I think markets at best are in a trading range and maybe even are at a short-term peak at this level.
This sounds super defensive. So final question, Sarah. Top picks, where are they right now for you?
Top picks. Yeah, I mean, one sector we like a lot, it's not a sector, just a category, is dividend growers. These are stocks that have underperformed year to date. They're companies that tend to grow their dividends. They're resilient in down markets. They have nice up market capture, but they don't perform as poorly as the markets do on the downside. They've lagged a lot year to date. Many tech companies don't pay dividends. So this sector's been left behind. I think this could have a catch-up trade if the market turns more defensive because of these headwinds that we talked about.
Sarah, great to get your input on the program. Sarah
Thanks for
Malika,
having me,
thank you as always for jumping on with us on a busy morning for everyone. About 15 minutes into the session, equities up by 0.9% on the S&P 500. Coming up, investors digesting the latest inflation report.
I think the re-acceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend.
Neil Dutta thinks this can continue. Team coverage up next.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say
perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend. I don't think the Fed has done enough. I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year.
Neil Dutt of Renmac, I don't think the Fed has done enough. Those comments coming after a subdued inflation print in America about an hour ago. Core CPI posting the smallest back-to-back increase in 2 years, leaving the door wide open for a Fed pause in September. Let's get to the team coverage. Bloomberg's Mike McKee, Ira Jersey joining us from Bloomberg Intelligence. Mike, first to you. That thesis, that argument people are presenting at the moment, the prospect that inflation can re-accelerate.
Yeah, let's run through this a little bit. On the Bloomberg, if you have a Bloomberg, you too can be a quant. We have a great program called ECAN, which breaks down all of the information in these economic releases into little bite-sized pieces you can see. And the first thing I want to show is what's happened up to now. We're seeing basically a trend that looks very good of not only inflation falling, but the contributors to inflation getting smaller every month. The only thing that really changed in the last month is the red there, energy, a little bit less of a subtraction from CPI, but everything else looks like it's getting better. But that's not what some people in the markets are seeing, and I'm sure Neil Dutt is thinking this too. You look at inflation forwards, five-year forwards, and what are they telling you? They're telling you that people think inflation after 5 years or over 5 years is going to be going up again. That has turned around in the last couple of weeks as financial conditions have eased, which is a real concern. And then what you have to look at is the yield curve, and you've seen that, John, invert in great detail, and now it's starting to go the other way. And the thing is, recessions don't start until the yield curve uninverts and the Fed starts cutting rates. And so is this a dangerous moment? That's what the Fed has to decide.
That uninversion, if we can call it that re-steepening, Ira, led by the long end. Usually when you're going into recession, it's the Fed cutting and you get this bull steepener with the front end rallying. It's been the long end selling off. Ira, what do you make of that over the last, not just this morning, the last month?
Yeah, so really the last couple of weeks, it's been a big part of the supply issue that you've seen the long end start to creep higher and versus the short end. So usually bear steepening, like you've seen over the last couple of weeks, it usually does not persist for very long periods of time, and I wouldn't expect it to this time as well. We have supply. We had supply yesterday, 10-year auction. Today we have a 30-year auction. I think after that, the supply story won't persist until, of course, we get additional supply next month. So we're in a situation right now where everyone's trying to do exactly what you're talking about, John. Will inflation reaccelerate? So there's a part of the market and a part of the rates market participants that are suggesting that we could see a reacceleration of inflation. So what does that mean for the curve? I think from my perspective, the single biggest thing that the Fed needs to do is try to get some of the cuts priced out for next year, because those easing of financial conditions that Mike just talked about is in large part because the market is still expecting interest rate cuts next year. You price those out, and that's just as good as a hiking in November if you say don't have a hike until the second half of next year.
Well, the Fed is entertaining that conversation to some extent for 2024. Ira Jersey, thank you, sir. I wanted to squeeze this in again. Mike McKee, happy birthday. We love you. Have a great day. Thanks for sharing your day with us on Inflation Day in America. Let's get you some sector price action. Here's Abby.
Well, stocks are higher on Mike McKee's birthday day, a real risk-on mood, maybe celebrating, up more than 1%. And we have all the big tech, mega-cap tech sectors really rebounding here, John, up more than 1%. The worst sectors are utilities, real estate, and industrial. So utilities, of course, defensive. So that is risk-on that they're underperforming. As for one interesting area, the overall solar area is higher, up 1%. But you can see Plug Power absolutely plunging this as gross margins disappoint.
Abby, thank you. Your trading diary up next.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg.
We've made progress while maintaining a strong economy. The words of the president in a statement from the White House just moments ago, following the inflation report, a disinflation report over the last couple of months. Your equity market doing nicely, up 1% on the S&P. That's the price action. Here's the trading diary. The US Treasury selling another $23 billion in 30-year bonds at 1 p.m. Eastern time. Shortly afterwards, the president continues his Bidenomics tour with remarks from Utah. Atlanta Fed President Raphael Bostic, Philly Fed President Patrick Harker speaking this afternoon. And finally tomorrow, rounding out the week with US PPI and the UMich Consumer Sentiment Survey. From New York City, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light. We constantly underestimate the strength of the U.S. consumer. This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we are going to get the latest on the CPI print. It was pretty darn right in line with expectations. We're going to speak with some smart people. Lydia Brosor, EY Parthenon, senior economist, will join us to break down that number. Mark Douglas, CEO of Mountain. He's one of the smarter folks in the whole digital media, digital advertising, streaming business. I'm going to get his thoughts on Disney and the streaming business in general. So all that's coming up. Kriti Gupta, host of Bloomberg Surveillance, she's got some good reporting out today on a big M&A trade in the luxury space. We'll get her thoughts as well. All in this hour. That's all coming up. But first, let's kick things off with Mr. John Tucker.
All right, Paul and Matt, it's a risk-on rally in the early going S&P 500 right now, up 1.3%, all attributed to the inflation print, consumer prices rising by a tame 0.2% for the month of July. This was both on the headline and a core basis. So it's fueling the idea the Fed might be done raising rates for now. And Fed futures traders now see a less than 10% chance of a September rate rise. Still, Neil Dutta at Renaissance Macro says the inflation fight, as far as he can see it, is far from over.
I think the economy is growing above trend. I don't think the Fed has done enough. And I think the Fed is kind of enamored with this soft landing view. They're almost wish casting this outlook. And I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up.
Right now, the 2-year yield 3 basis points lower. That is at 4.77. Shares of Disney, they are up right now, $1.51, $88.90 a share for the second time less than a year. Disney raising prices for its streaming services, Disney Plus, Hulu, and ESPN, part of what we learned from the earnings report. And, hybrid work has made the ritual of the Friday happy hour a tough sell. The fizzle of Fridays has bars and restaurants doing everything from hiring midweek DJs to offering cheap drinks earlier in the week. I know they have happy hours starting at 12 o'clock or on 57th Street.
Oh, you know that?
Yeah, no, somebody told me about that.
All right, good to know.
Yeah, no, hybrid work is killing the happy hour on Fridays. So
That's sad.
I get that, though.
Get out and do your part.
Yeah,
people.
help the local economy.
But don't you think it's better if they just broaden happy hour to basically like all day?
Exactly, that would work. Yeah. One of the best.
There's a place I used to go to on the shore on the weekends. The fishermen would be in there at, get this, 7 a.m.
Oh, yeah. Well, yeah.
Makes sense to me.
Yeah, they go out at 2 or 3 o'clock in the morning.
They need it.
Catch the fish, yeah. Those
Absolutely.
are some hardy souls out there, as is John Tucker. Thank you so much for that, John. Matt Miller here, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so go check us out. Head over to YouTube and search Bloomberg Global News. So, Matt, we had, I think, a pretty solid inline inflation print. The market seems to like it. S&P up 1.3%. So, I mean, I think the Fed, if they want, they can hang around with this kind of level.
Yeah, I thought Neil Dutta's take was really interesting on surveillance this morning. Of course, he's an optimist, and he thinks that we're going to have above-trend growth going forward. He thinks that we're going to all have to up our forecasts for GDP. Nice. But he thinks that with that, inflation is going to come back as well, or at least there's a danger of that, and the Fed needs to continue to be cautious of it.
All right. WTI crude oil, just a little bit off today, but still $84 a barrel right there for WTI crude. Gasoline higher as well, so some of those key inputs. Bailey Lipschultz, he joins us here in our Bloomberg Interactive Broker Studio. He covers the markets for us. Bailey, what are you looking at today?
No, as you all mentioned, I mean, as JT mentioned, right now about a 10% chance for a rate hike in September. The big thing that stands out to me, though, when you look at that WIRP function, WIRP, traders pricing in 3 cuts by the end of July next year. So could be interesting to keep an eye on, and that is probably why you're seeing the risk-on rally with tech really leading the way. One of the best performers that I have my eye on, though, is Alibaba, right now up close to 7%, better than expected revenue and profit. That all boosted by a growth comeback at its e-commerce core unit, Taobao and Tmall.
Yeah, my boy Joe Tsai back in the big seat at Alibaba, making things happen.
And another markedly outperformer is Capri Holdings,
yes.
up 56% right now after being agreeing to be bought by Coach parent Tapestry for about $8.5 billion, or $57 a share. Tapestry down as much as 10%. So M&A happening.
See, Tom Keene doesn't even consider those brands like Michael Kors and like as luxury. Tom's like he's please.
I don't think they're considered luxury by themselves either, right? Wouldn't they be considered like aspirational or something else?
I would say if I can afford it and could afford it, it's probably not luxury. And like Coach and Michael Kors, I would say is definitely more affordable if you go to your local Macy's or even.
Yeah, I would guess that the Bloomberg Intelligence analyst also wouldn't throw those in a luxury category.
Deb Aiken, she's in London. She knows luxury firsthand.
But I remember when Coach and Michael Kors were owned by Coach and Michael Kors. Like, what's the whole deal with Tapestry and...
Well, Kriti Gupta's going to join us later. She's got some very good reporting on this, and she says basically consolidation is a thing in the luxury business.
Yeah, I mean, and I will say Tapestry, to be fair to them, they do own Versace, and I would say I cannot afford Versace, and Versace is definitely in the luxury category.
I don't think I've ever even seen Versace for sale.
Where's that? Bloomingdale's right next. We have Bloomingdale's literally across the street.
That's the culprit.
Get in there. Anything else there, Billy?
Plug Power down 12%. The green hydrogen company continuing to report weak results, weaker than expected margins. Morgan Stanley said the gross margin at negative 30% compared to consensus at minus 9%. So seeing those shares down 12% this morning, and really the opposite of what you want to see when you look at a chart going down to the right, down about 67% in the last 12 months. So it does not seem like they are doing much to turn around the business, but it does seem, again, broadly speaking, in the market, big drivers for the S&P, Microsoft, Apple, Tesla, Amazon, NVIDIA, Meta, all the big guys are up after yesterday's weakness.
Here are 2 headlines. I'm just looking at the Bloomberg Terminal. College spending jumps 38% in a decade, funded by tuition boosts. I'm just thinking I've been writing college tuition checks for the last decade, so I'm all part of that. And then New York City apartment rents spiral higher, even as tenants balk at costs.
$4,400 a month was the average rent. Doesn't that seem like out of reach for most people?
It does. And then, okay, I'll make that big investment if I'm going into the office in New York City. But if I'm staying at home, what's the point? I don't.
I mean, I get that there are people who just absolutely love New York City,
right?
Who absolutely love being in Manhattan or looking at Bailey. I'm going to guess Brooklyn or Hoboken.
Yeah, that's Hoboken. I will say my Hoboken renewal letter, 22% increase, up to just around $4,000 for a 1-bedroom apartment.
Oh,
so
unbelievably expensive.
Yeah. All right, Bailey Lipschultz. Good luck with that. Billy Lipschultz, she covers all the markets here for us at Bloomberg News. We appreciate getting him in here. Disney's another name that kind of was on the radar screen for a lot of investors. They reported numbers last night, a little bit better than expected. People are looking at the streaming business. The losses there were a little bit lower. That's good. It's all part of Bob Iger's CEO's plan to cut costs here. But there's as many questions around that company as I've ever seen in my 30 years of covering it. When you see a business like ESPN, which is just the rock solid core of this company for 20, 25 years, now you're wondering whether you even want to own it. Mark Douglas joins us. He's the CEO of Mountain. He knows a thing or two about this business, about the media business, about the digital advertising business. Hey, Mark, you take a look at what is a stalwart media company like Disney, and boy, there are a lot of question marks there. What are some of the key issues for you when you look at Disney?
Well, I think the fundamental issue is Disney, has magical prices for everything they do, meaning the prices are generally pretty high. And I think they're not really delivering magical, experiences or magical content right now. And they keep looking externally for what are the factors that are affecting their business rather than just looking internally. And so even if consumers are spending less money, then deliver the magic and take a bigger share of wallet. But, I think they're full of excuses right now. And until they look at themselves, I think this kind of like we're not doing as well as we used to is going to continue.
So what's the answer on the whole streaming thing? Do streamers really make money, Mark? Because I was listening to Paul interview the head of, I think, SAG-AFTRA, and she was saying the streamers make $30 billion a year in profits, and they want a piece of it.
Well, I mean, obviously Netflix is definitely making money, and I think you're going to see because Netflix, their ad-supported tier is, off to somewhat of a slow start, but it's just hugely profitable for them. What they're doing in password sharing again is just hugely profitable for them, and my opinion is Netflix is going to kind of enter a new era of just increased earnings. And I think anyone else can get there, but it starts with, people want to be in the parks. People want to watch Star Wars. They want to watch new Disney movies, and they want to do them at the same rates that they have in the past. So I think Disney can absolutely get there. I'm a little concerned that, they're talking about reducing their investment in streaming or moving away from ESPN as if people don't want to watch sports anymore. And so it's as you opened, it's a little bit of just like everything seems to be in turmoil where, I don't think the consumer has actually changed that much. It's Disney's the one that seems to not know exactly the direction they want to go.
Yeah, and that even applies to the film business, which had been, ever since they started buying all these great brands like Pixar, like Marvel, like the Star Wars franchises, it was literally guaranteeing them 2 to 3 to 4 movies per year with a global gross in excess of $1 billion. Now, even that business seems like it might be in a rut. They've delayed and pushed out a lot of release dates. Maybe some people are saying, maybe we're oversaturated with some of these franchises. And then you just look at Barbie, kind of a new original movie. That's over $1 billion in box office. So do you think Walt Disney's lost some of their magic when it comes to the film business, Mark?
Yeah, I think, so we've talked about sports on the show. I mean, when your team's not doing well, everyone needs to remember how to catch the ball and hit, right? Like it's baseball season right now. And the best managers just go back to basics. And I think Disney's problems are not huge if they just go back to basics. And if they go back to basics, they kind of own these huge segments of the market, parents, children, sports, and when you see a company that owns segments of the market, just like dominates segments of the market like that, and they're a little confused as to what they should do, like just go back to basics, get a little less focus on near-term results in Wall Street, and just essentially kind of grow yourself out of that. And especially when you have the kind of capital that Disney has to do it also. So, I mean, they're not at risk of running out of money unless their losses continue for a very long time. So, I mean, that's my advice as a CEO. Bob Iger obviously is a very smart guy, and he's going to, follow what he thinks is best. And so we'll see how this plays out.
You have any succession advice for Bob?
Well, the last one didn't go well. Didn't go any better than the show, Succession. So I think he's going to have to really fix this before he brings in someone else to grow it. Yeah, so that's it. I don't think he's there for 1 year. I think this is going to take a few years.
I haven't seen the end of Succession, so
we won't
spoilers.
We won't spoil it for you. Hey, Mark, it's just when you think about Disney, they're like all the media companies really exposed to these strikes that we're seeing with the writers and the actors. You're so involved with the advertising side of the business, the digital side of the business. What's your take on these strikes here? Because boy, both sides seem really, really entrenched.
Yeah. Well, I think first, from what I understand, the anything that was already in motion on the film side is allowed. That project is allowed to get completed. So it's actually going to take a few more months before, like, literally everything is truly shut down.
Yep.
And then I think, the streamers and the studios and things like that. I mean, cash is king. They have a lot of cash to wait this out. So this is it's hard to predict how this is going to go. But if it's a war of attrition on money, that's going to favor these big studios just kind of waiting it out to get a deal that they think is reasonable.
Well, and Disney has an added bonus that Netflix doesn't in the parks business, right? I mean, I heard yesterday they get 70% of their
operating income.
Operating income from the parks.
Well, that's the good news. The bad news is it's because the other businesses have gone down so much,
Exactly. The movies in particular, I think, have really been hurting them.
But you're right. And the parks business is rock solid, has always been.
The big franchises, like, I don't follow all the superhero movies, but that and Star Wars and even Pixar, they just haven't been as successful as they once were, have they?
Yeah, and so I mean that again, the content is a part of the experiences that Disney sells. And so, they have to look inward and say, is this because consumers don't want to watch Star Wars anymore? Or is it because maybe we're not doing the greatest job in giving them what they want? Because if you give them what they want, they're going to watch. And so, I'm going to keep beating that drum. It's back to basics to grow this business.
Hey, Mark, give us a sense of kind of the advertising market out there you're so involved in on a day-to-day basis. I can't imagine it's very good because, I mean, I'm just thinking the economic environment is kind of uncertain here. What are you seeing out there just in terms of overall advertising?
Yeah, so if you're a performance advertiser, your Google, your Meta, Meta's up year over year. Even TikTok, Amazon, companies in the performance space, you continue to do quite well.
Okay.
If you're in the brand advertising space, more of the big TV networks, it's a bit up and down. It just literally, I think, month to month, the budgets are going up, they're going down. So it's not like this huge era of growth right now, but it's also not like a bloodbath. I think that the kind of retraction in spending on brand advertising has already occurred, and it's just a little less predictable. But overall, I think, from everyone I talk in the industry, my own experience at Mountain, it's relatively solid, given the kind of how much the economy and economic news are just constantly up and down. It's pretty consistent right now.
All right, Mark, great stuff as always. Mark Douglas, President and CEO of Mountain, giving us kind of his thoughts on what we saw from Disney and some of the streamers. Matt, you interviewed the president of General Motors yesterday, and that Escalade electric looks awesome.
Yes. I mean, I hate to say that I love it because, the Escalade has always had a stigma of sorts for kind of, I guess, wealthy, suburban moms, or also kind of like rappers and stuff. It's been seen as, I think, an excessive, product. But I like excessive things, and to me, it's a huge competitor to Range Rover.
Yeah, it's interesting. I remember.
I got to find out what Mark D drives.
Right? Yeah, I don't know. Interesting. So. They're going to make. I tell you what I take away from your reporting and from what we hear from all these companies on the car side. They're going all in on electric, and I'm just not sure kind of where the demand is. I guess that's one of the questions.
That was the first question I asked.
Exactly.
Him. After people bought the Hummer, the early adopters. Who's next?
Right. Exactly. All right. We'll have more coming up. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, following a record high earlier this week, shares of Novo Nordisk are down more than 1%. This after the Dutch drug maker disclosed the supply of its obesity medicine Wegovy will remain restricted in the U.S. CEO Lars Bergard Jorgensen tells Bloomberg he's not concerned about supply issues.
This is a really unique opportunity for Novo Nordisk. We have seen a tremendous willingness to use our obesity medicine, not least in the US, but also in Europe, where we have launched. We have this week announced a set of really attractive cardiovascular data, not yet in the label, so we cannot promote them. So this is just going to push the demand even bigger.
The data Bergard Jorgensen referenced is from a study that shows Wegovy decreases the risk of heart attacks and strokes for overweight patients. Disney is raising prices again for its streaming services. More on that from Bloomberg's Charlie Pellet.
Beginning October 12th, the ad-free version of Disney Plus will cost $14 a month, up from $11 currently. The ad-free version of Hulu is going up by 20% to $18. It is the second price increase for Disney Plus in less than a year, and it underscores the company's drive to make its streaming business profitable by September of 2024.
Thanks, Charlie. Disney stock is now up more than 1.25%. And Meta is looking now to rehire many people it laid off several months ago. The tech giant shed 25% of its workforce in multiple rounds of cuts that ended in May. Those layoffs are part of CEO Mark Zuckerberg's plan for what he calls a year of efficiency. Currently, we have shares of Meta up more than 1.75%. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Plan. Risk on rally after the relatively tame inflation report that we got this morning. The technology shares, of course, they are the biggest beneficiary right now. The NASDAQ 100, that is up about 1.6%. Microsoft, Apple, Tesla, Amazon, they're leading the charge there. Meantime, the economic front, we also got the weekly jobless claims. They rose to 248,000, and so that topped estimates. That's considered Fed-friendly as well. Right now, the S&P 500